made the point that he thought that the arrival of the present chief of the WHO had taken the WHO backwards, and that it had become quite political. And he therefore said that it was China had managed to get others to ensure they voted for this particular candidate at the time. And that's why the US, he said, has decided to withdraw and use the money, he went further to say, to set up areas and institutes around the world that will actually deal with the sort of things he said the WHO should have been dealing with.
Does the UK government agree with that?
Well, clearly the UK government doesn't, has decided to stay with the WHO. I think I have to say amongst political circles here, there has been a lot of concern about the very poor performance of the WHO at the time of the original outbreak of coronavirus. It's absolutely clear now to anybody that knows it that the human-to-human transfer was almost certainly known to exist back in November, and yet it turns out the WHO didn't appear to press the Chinese authorities, A, for really serious detail on that, and B, to accept and admit that they had a problem on their hands early enough. And there's no question now that that led to all sorts of problems that we've now seen on a wider global stage.
Sir Ian, I was thunderstruck this weekend in this 4 or 5 day marathon EU summit of the aloneness of Britain. Britain wasn't there, which I'm sure is something you were very happy about as a staunch supporter of Brexit. You have asked Europe to move on. How has the Brexit debate changed for the people of the United Kingdom after witnessing a summit that they were completely removed from?
It's quite interesting. I mean, I watched the summit as well, and one thought came to my head, which is that the trouble with the outcome of this summit was that the UK would have, probably alongside Germany, had disproportionately to have put a significant amount of money in and become committed, whereas right now British people are quite interested in seeing that sort of money invested back in the UK, certainly in the light of the COVID-19 outbreak. So I watched, but most people in Britain watched rather tangentially for the first time, and the news coverage was quite slight, really. So it is a product of leaving the European Union, but I did think it also rather showed the European Union at the end of the day they had some kind of compromise, which I don't think will probably work at the end of the day, because, you know, the northern European countries simply don't want to bail out the southern European countries. They have a real Eurobond problem, and whether or not the Eurobonds are what we would call in America federally guaranteed, or here gilts backed by the Bank of England, I think they're in real danger in Europe of borrowing money without the guarantee of the central bank. So there's lots of problems in the financial world in Europe at the moment.
It's hugely experiential, and there was the experience this weekend of being removed. How does that change the Brexit dialogue between Conservative and Labour?
Well, not really. I think most, now all political parties accept that finally that Brexit is done. It now needs to complete it with the trade arrangements, which is as much in the interest of Europe as it is the UK. So that debate really is toned completely down. As I say, watching these discussions tangentially on the television every now and then, switching it on to see they've got another day to discuss it. For the first time, really, it wasn't headline news in the UK. It was about 4th or 5th item, and simply only a kind of general statement that they still hadn't agreed. So in a way, that rather emphasized the fact that we have taken the decision to go and leave, and we're not going to get caught up in these endless discussions about how much money to put into the budget.
China has vowed retaliation after the U.S. forced the closure of its Houston consulate. Where does the UK fit in all of this?
Well, the UK has, at last, I think, come to the conclusion that there are issues with China, and China is posing a significant threat in the way that it behaves internally and externally, and that they're breaching, too, of all the rules around the free market, you know, the espionage they use to try and steal data to catch up, the problems that they've got with regards to their breaching of things like subsidies on companies like Huawei. I mean, Huawei's won all their business because they bid so much lower than everybody else and then basically have driven pretty much every other systems company out of business except for 3 now in the free world. So these are issues beyond the nature of their government and their aggression on their borders, South China Seas, Taiwan, Hong Kong has been appalling. And then, of course, there's the Uyghurs. So this is all mounting up. So the UK has taken a stance. They've said Huawei won't be the provider for the 5G going forward in the longer term, and they've now lifted the extradition treaty and suspended it with Hong Kong, so the Chinese can't use it to try and get after people they want to take back to China. So all of that is part of a toughening up. Yes, China's got aggressive, and they don't seem to bother with diplomacy anymore. They seem to do a lot of shouting. But the question really is, do they want to pick a fight now with the free world? And the UK is quite influential in that regard. And I've set up a thing called the Interparliamentary Alliance on China, which is made up of left and right in America, the UK, and now in 18 countries, and India about to join. And all of them are united in saying that we need to build an alliance of the free world to say to China, you can't go on behaving like this and expecting everybody to just kowtow to you and allow you to get away with it. So that's important. America, I thought Pompeo yesterday was strong and positive about building that alliance. As I say, in America, Democrats and Republicans agree. Here now, the Labour Party and the Conservatives agree. So this is mounting pressure, I think, on China.
Sir Ian, thank you so much for joining Bloomberg today. Ian Duncan Smith, of course, a former Conservative Party leader. We've got much more coming up. We're watching very carefully for any news flow out of China on which consulate they would be closing. That is speculation at this point. There is no speculation that there is a wall of trading on the NASDAQ. Adina Friedman, an important conversation coming up. This is Bloomberg.
Opportunity knocks at the door. Don't say, blimey, I've still got my pajamas on. Say yes to stuff and it will take you interesting places.
We're clearly going through some very unusual times and, enormous difficulties getting groups of people to agree on things.
From Bloomberg's European headquarters in the City of London, join us on Leaders with Lacroix.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
Bloomberg Surveillance. Good morning, everyone. Francine Lacroix in London. I'm Tom Keene in New York. We're watching very carefully the news flow out of Houston and out of China as well, and the closing of the Houston consulate by the United States of America, this of China. And, of course, we're looking for the tit for tat and the speculation about which city it will be in China as well. So we'll look for that right now. It is a four-letter word. 1, 2, 3, 4. Yeah, it's a four-letter word. And the word is sell. And that is a word of bravery if you're looking at Tesla. Garrett Nelson is our CFRA and joins us right now on the Tesla Derby as well. First, Garrett, let's get to first principles. Is Tesla an automobile company?
Sure. Well, thanks for having me. It is an automobile company, but it trades more like a technology stock. The multiples at which it trade at are more like a high-growth tech company than an automobile company such as Ford and General Motors, which, you know, their PE multiples are typically in the mid-single digits. You know, Tesla's multiples are many times that. So, and that's because of the growth expectations that lie ahead.
Do you believe the China numbers? I mean, if this is a revenue story and it's got Amazon-like revenue, et cetera, up 20%, up whatever percent per year, there's some point where that ends ex-China. Is there a truth to the China story?
Sure. So they just entered into China late last year when they finished constructing their factory near Shanghai there. So they're reaping the benefit of the higher automobile production from that factory. And that's going to be one of the main drivers of their second quarter earnings later today. So, but it's increasingly becoming a global company. They've just broke ground on the factory in Germany. They're moving as fast as they can to construct that. And then, of course, there'll be a new factory in the U.S., likely in Texas, we think, which they'll be moving forward with very soon.
Garrett, good morning. How many more vehicles do you think Tesla will sell in 2020?
Sure. So we think their vehicle sales will be up about 25%. The big question heading into the quarter, they've guided for vehicle production of about 500,000 for the year. We think they're going to fall a little bit short of that guidance, mainly because their Fremont factory in California, which accounts for 70% of all their automotive production, was down for almost 2 months because of COVID. So we think they're going to fall short of that goal, and they'll probably update that guidance in the earnings release.
What will be the catalyst for reality in Tesla? So far, the reality crew, those that read Graham, Dodd, and Cottle, have been wrong. What will be the catalyst to get this stock back to the kind of dynamics that we traditionally associate with an automobile company?
Sure. So we downgraded the stock to a sell from a hold to a sell on Friday because we think it's a story stock that's gotten ahead of underlying fundamentals. And we're seeing some red flags surrounding the story, several things that we're seeing that make us more cautious on the shares. For one, there's been a lot of short covering in the stock over the last year. So the current short interest is only about 7.5% of shares outstanding. 12 months ago, it was over 23%. So we think a lot of the move up is the result of a short squeeze. Recently, they lowered the price on their new Model Y vehicle. Remember, they just introduced that vehicle in March. They're already lowering the price, so we think that could equate to a demand issue there. There's been a big drop in vehicle registrations in the state of California, which is by far their largest market in the U.S. And they're also entering a major CapEx cycle with these two new factories that they're breaking ground on. Finally, earlier this year, Tesla did an equity issuance. They issued equity at $767 a share, and now the stock price has more than doubled that. Elon Musk himself tweeted in early May that he thought the stock price was too high when it was around $800. So, you know, we think there's the possibility of another equity issuance here sometime after the earnings release. So, you know, for all these reasons, we changed our opinion to sell.
But Sal, I mean, are we talking about a bubble? I mean, how much can it actually correct by, Garrett?
Well, our 12-month price target is $1,100. So, you know, that's, you know, roughly 30% downside from current levels. But really what everyone is looking at with the earnings release this afternoon is the GAAP earnings number. If they post a GAAP profit for the quarter, they become eligible for inclusion into the S&P 500 index. And that, of course, would lead to another wave of buying from index funds from rebalancing. So everyone's focused on the GAAP EPS number. The problem is there's no guarantee they're going to post a GAAP profit. Last quarter, it was a GAAP profit of 8 cents. They had the shutdowns in Q2 due to COVID. The consensus is for a GAAP loss of $1.29 for the quarter, but the stock keeps running up like, it's a foregone conclusion that they're going to post a profit for the quarter. But we would just caution investors, there's no guarantee that will happen. And, there's been a lot of speculative buying, especially from retail investors ahead of the quarter, assuming that they will get there. But if they don't, we would cautious, watch out below.
Thank you so much for the insight. Garrett Nelson there, CFRA, a senior equity analyst. Now, coming up a little bit later today, Pershing Square's Bill Ackman on TV and on radio. Don't miss that conversation, 1 p.m. in New York. That's 6 p.m. in London. And this is Bloomberg.
I'm placing a new order to sell short Japanese yen at 106.967. So new order placed to sell short Japanese yen at 106.967, and it's already executed. So position open for Japanese yen.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They move the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance. I'm Ritika Gupta. Let's get the Bloomberg Business Flash. The parent of Snapchat is showing how hard it is to predict business direction during the pandemic. Snap missed its own forecast for user growth last quarter, and it's holding off making projections for the current period. Snap says the events that usually drive third quarter ad sales, like sports, movies, and back-to-school shopping, can't be counted on. And 4 women who used to work at Google are seeking class action status in a gender pay disparity suit against the company. They've asked a state court in California to let them represent more than 10,000 peers. The women say in a filing that Google paid women about $16,800 less per year than a man in a similar job. Google says claims in the lawsuit are unfounded. And that's your Bloomberg Business Flash. Francine?
Ritika, thanks so much. Now, as we continue to track the virus, Bloomberg has developed a unique partnership with the leading authority on COVID-19. Johns Hopkins has been at the forefront of the international response, and every day we bring you insight from experts in public health, infectious disease, and emergency preparedness. Well, joining us today is Lauren Sauer, Johns Hopkins University Assistant Professor of Emergency Medicine. Thank you so much for joining us. Lauren, first of all, what did we actually learn about antibodies? So antibodies don't last long. Is this only for antibodies once you've had COVID-19 mildly, or could it also be antibodies created by vaccines?
We are working really hard to understand the difference between the antibodies created by a natural infection and the antibodies created by some of these vaccine candidates. In past vaccine trials in other viruses and other infections, we see immune response. We see antibodies produced in this first phase 1 and 2 that these vaccine trials are in, but it doesn't always mean that we've conferred protection. And so as we do more work on collecting data around these neutralizing antibodies in particular, we'll start to understand better, particularly when we get into that phase 3 of these vaccines, whether or not these antibodies mean people are protected.
Lauren, can we be protected from COVID-19 with T cells, even if an individual does not have the antibodies?
So there's a lot of work that's happening right now on T cells versus antibody response. And so normally in a traditional vaccine sort of landscape, you would spend several years trying to figure out if the vaccine itself needs to be good at producing antibodies in the body, or if we have to induce T cells, or if you need some combination of the two. And so right now we don't have that sort of timetable. So we're going forward with these approaches that the AstraZeneca and the mRNA vaccine from that we just heard about last week, I think. And so I think we'll find out as we move forward. A lot of people are working on the T-cell experiments to understand what role they play, but we still need a little bit of time to understand how they both work in the body.
There was quite a lot of hype about these vaccine trials that were successful. How far away are we from actually making sure that these vaccines are safe and usable and knowing how many doses?
Yeah, we have a few candidates right now, which is incredibly promising and incredibly fast. But we have seen vaccines in other infections be immunogenic. And then when you get to phase 3, which is that space where you're seeing, okay, does this really broadly protect the population, and can we move this into large-scale production and get a vaccine out to the world? Then sometimes in that phase 3, we don't actually get that broad protection that we need to have a successful vaccine. I think everyone is very positive on the results. I think, the safety data look good. There is still some adverse events in these vaccines, but I think as we move into phase 3, we have I think 3 promising vaccine candidates right now, which is incredibly, incredibly good.
Lauren Sauer, thank you so much for joining us today. She is of Johns Hopkins, and be sure to check out VRUS Go on the Bloomberg for the latest information. Also tune in every day for our exclusive conversations with Johns Hopkins experts for an inside look at battling COVID-19. The other big story of the day is, of course, what's happening in the consulate, the Chinese consulate in Houston. The futures on the S&P 500 are actually dropping. We're also seeing a similar move for European stocks after a flare-up between America and China added to concern on the markets about the deteriorating relationship of these two economic superpowers. I'm looking at treasuries. They're edging higher. The dollar also briefly rising. Now, coming up, join Tom Keene, Jonathan Farrer, and Lisa Abramovitz for more Bloomberg Markets and Bloomberg Surveillance simulcast on Bloomberg Radio and Bloomberg TV. That's from 7 a.m. in New York in just a couple of minutes. The other thing we're watching is yuan. It fell. Both gold and silver actually trimming some of their gains today. This is Bloomberg.
sometimes you don't. The trick is to be ready for anything. Pablo from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
There's going to be a lot more unemployment coming, and certainly a shift from what was temporary unemployment into permanent to some degree.
These companies are now starting to hunker down for a longer, more protracted recovery. And so they have to right-size their businesses.
Not everything's going to turn on right away, and we're finding out some things that were turned on and be turned back off for a little while. It's going to be bumpy.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance with equity futures slightly negative. We're live on Bloomberg TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Tom Keene, how many times have we woken up in 2020 to say rising US-China tensions? And this morning, we're doing it again.
I'm not a big fan of the phrase developing story, but John, this is developing as really the entire world waits to see how China will respond to the closing of the Houston consulate by the United States of America. John, you know, you go to Twitter, you go out, look at all the speculation. I would suggest, John, right now it is speculation about what China will do, but there's no speculation that they will do something.
But Tom, there is a broader story here to acknowledge, whether it's the economy and trade, whether it's foreign policy in the South China Sea. The common denominator here is trust, Tom, and a lack thereof. And you see it increasing and playing out publicly, even more so in the last couple of months.
Yeah, and it's worldwide. Ian Duncan Smith was on, and Sir Ian made very clear that the Pompeo visit had an impact in the United Kingdom. I believe Secretary of State Pompeo right now is in Denmark. I may be wrong on that, but there's a global messaging here about China and what to do with their economic and military assertiveness.
Lisa, for the equity market, we're down just 8 points, so the S&P 500 off by 0.25%. Market participants don't know what to do with that story. This has been the takeaway for me for the last several weeks. Every time we see a headline like this, we might gap lower, we come back pretty quickly.
Well, trade tensions were a clear bleed through into the economy. This has a sort of unclear result, and that seems to be what a lot of traders are grappling with. The less fuzzy result here that we're looking at is the economic development, and getting a read on that, we're going to be getting the EIA crude oil inventory report at 10:30 a.m. I'm very interested in that, given the fact that we got data out of the U.S. yesterday showing the biggest jump in oil inventories in the U.S. since May, leading to a decline in demand. 1 p.m., U.S. is poised to sell $17 billion of 20-year bonds. Yields currently 1.06%, a record low for that issuance. Why doesn't the U.S. sell more long-term debt? A debate. Also, aftermarket, Tesla and Microsoft reporting earnings. Just to give you a sense, Tesla up 275% year-to-date, John.
Just 225. And if you say anything about this stock, you get a ton of hate mail in about 2 minutes. Tom Keene's lived it, I've lived it, I'm sure you've lived it as well. You can't question this move, otherwise the hate mail starts almost immediately. So let's get Amy Wu Silverman to talk about this name, shall we? RBC Capital Markets equity derivative strategist. Amy, fantastic to catch up with you. Big earnings day with the likes of Microsoft and Tesla in the mix. How important is today for you?
Well, good morning, guys. I'm interested in getting the hate mail, I guess.
I don't think you won that, Amy. Give it a miss. Give it a miss.
No, I mean, look, it's to be honest, I actually almost forgot that Microsoft was reporting as well. I think people are so focused on Tesla, particularly for those of us in the options market. It has been a name that has completely upended the historical relationships that we have typically seen, stand for years and years in the options market. And what I refer to specifically is, the call option pricing in Tesla has been inverted for a long time. So meaning the call implied volatility is greater than the put implied volatility. That just typically does not exist for single stocks. It has multiple times for Tesla. It's inverted today going into earnings. And, you know, obviously S&P inclusion is key to watch, but there's also a lot of technical dynamics that are going on with the name. You know, it's pricing in about a 16% move tonight. And I think that's probably fair, even though that looks historically high, just given how important this particular earnings is to showing potentially the path towards S&P inclusion.
Amy, I'm sure you sat in Princeton statistics and derivatives, and there was a point where your eyes glazed over the square root of n, which is the sample size. The sample structure of the equity market now is not normal, where we're all weighted towards 6 or 7 glory stocks. Can you do actual derivative analysis, given how odd the market is?
Yeah, no, it's really interesting. And, you know, we look at these performance numbers, and a lot of people, you know, use them and say, you know, look, the market's done this and done that. And you're right. Sample size of N has essentially become, you know, Amazon, Netflix, Bang, or what have you, right? It's a handful of names. You know, look, it's still obviously the ability to look at derivatives is still there. It's just that you kind of have to adjust a few things. And one of the things you have to adjust for, I think, is, you know, when we talk about the different factors, so like momentum versus value, which people have watched very closely for a very long time, you know, I think it's important to acknowledge that when we say momentum, we basically mean tech. And when we say tech, we basically mean these, you know, 5 to 7 stocks. And so, you know, looking out 6 months, when we talk about whether or not these factors will change, we're essentially just saying, look, are these 7 stocks going to go up or down? And I think people who are trying to make these more factor or index-based inversion comments, really it comes down to what you think are happening with these names.
Well, Amy, there's a question. One reason why you're so great, one of the many, is that you look at the fundamental analysis as well as the technical analysis based on positioning right now. Would you recommend hedging a bit against these big 7 names that basically are dominating the index?
Yeah, and to be quite honest, I would, you know, in the options world, we often just think about things in terms of risk-reward. So quite simply on a risk-reward basis, meaning these are names that have had unbelievable rallies to the point where, you know, similar to Tesla, their options landscape has inverted. So essentially, you know, one stat that I thought was interesting was out 1 year, you know, you can sell 60 to 70% upside in something like Netflix and own 30% downside. So meaning, you know, you're retaining substantial upside because the out-of-the-money call options are so expensive to own a hedge. If you're just, you know, if you're a portfolio manager who owns these names, that risk-reward to put that protection on makes a lot of sense. You know, even if you believe that we will continue to get flight to safety in these names. It's just about that risk-reward proposition being at historically attractive levels.
So the risk-reward proposition, where is it historically high when it comes to taking risk right now?
So one thing I thought was interesting is that this weekend, you know, one of the pieces I wrote was about how short-term I was very surprised at how complacent the market is. And to be quite honest, I wasn't even thinking about China. I was just thinking anytime the Republicans and the Democrats are supposed to agree to anything, it seems like volatility should be a little higher. And, you know, obviously there's China-U.S. tensions in the headlines today, but kind of the next few weeks, we're also going to have an agreement or lack thereof, we don't know yet, on the CARES extension. I think that'll be very volatile. But coming into this week, option market prices were going down, in particular in the short end, and I think that will probably change and need to rise.
Well, Amy, put that into English for us. When you say the option market remains remarkably complacent, what do you mean by that?
So basically, you know, option prices to own a hedge, to buy downside protection was actually relatively attractive for August and September coming into this week. Now granted, given the headlines today, everything's probably going to start to pick up. But essentially what I had said over the weekend was it probably makes sense to own, either put protection or protections through collars as selling upside to own a put, given that prices were, call it, below average over the last kind of pandemic period.
Amy, are you satisfied that we've seen the capitulation to the upside? I've just got a headline across the Bloomberg terminal. Let me bring it to you. It says the United States is in a pact with Pfizer for 100 million COVID-19 vaccine doses. This is the upside risk that I think people are nervous about, Amy, that we get that headline, that game changer, and people aren't positioned for it. Are you satisfied that enough people are allocated to a move for the upside that you should move the other way?
Yeah, it's a great question, but just to put a wrinkle in it, it comes down to that sample size of N question. Because look, the minute we get a vaccine, I think we're going to see an extremely violent rotation out of momentum and into those cyclical and value names. Now, what that means is all these names that were, COVID flight to safety names, so your large tech / momentum names, I think they actually begin to underperform if we believe everyone's going to go out and be the real world again. There's not going to be this need as much for the work from home tech names. And so you're going to see an interesting divergence in something like SPYs versus Qs, because Qs has become extremely heavy to those momentum-based names. And so you can actually see a sharp outperformance, I believe, of S&P, while you see something like Qs underperform, which means, again, owning that downside, which is remarkably risk-reward attractive, makes sense.
Amy, brilliant, as always. Love catching up with you. Important day as well. Amy Wu-Silverman there of RBC. As we count you down to the opening bell in New York City, 2 hours, 20 minutes away. Equity futures recovering here, Tom. We are down just 0.2% on the S&P 500. The story from yesterday that follows through into Wednesday is a weaker dollar. Tom, as this session grows older, that dollar gets weaker once again. The Aussie outperforming, the euro up by 0.4%. For me, at least, Tom, that's been the story of the last 24 hours, that renewed dollar weakness.
No, you've got the blended DXY index through 95. That's a huge deal, John, to see a handle of 94 on DXY. And you see it in the euro-yen dynamics and even in sterling as well. John, what we didn't get to Amy on that I think is so important is usually what gets people into trouble is leverage. I really agree with her point on the sample size here is so odd, but the huge mystery going into August is the leverage, the use of leverage within the system.
The use of leverage, and as to whether people have really allocated to this rally. Lisa, that's been the story for me over the last several months. We've seen it in the fund manager survey over from Bank of America for the last several months, that slowly it's come down. Can you get a clear read, Lisa, on whether we've seen that capitulation just yet in this market?
It doesn't seem to be the case, given the fact that after a headline like this with the U.S. agreement to buy Pfizer vaccines, you see the NASDAQ turn positive. It seems like there still is more there. When you talk, though, about leverage, John, the leverage has been moved to the corporate debt sector, where you still see a record amount of debt issued.
Equities recovering this Wednesday morning. Coming up on this program, Adina Friedman, NASDAQ president and CEO from New York City this morning. Good morning. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. China calls it unprecedented escalation. The U.S. has ordered the Chinese consulate in Houston to be closed, according to the State Department. It's to protect American intellectual property and Americans' private information. Beijing has warned that it will retaliate. Last night, Houston firefighters went to the consulate after reports that documents were being burnt in outside containers. President Trump has rebooted the coronavirus briefings with a shift in tone and a warning. He was notably more reserved than in the past. He encouraged Americans to wear masks and avoid risky behavior. The president promised that the virus will be defeated, but he said it probably will get worse before it gets better. Republicans putting together a coronavirus relief plan broadly support the idea of more stimulus checks to individuals, but they're expressing doubts about President Trump's call for a payroll tax cut. The differences between Republican senators and the White House threaten to push any action on the stimulus into next month. The Democratic Party platform is sticking close to Joe Biden's line on major policies. According to a draft of the document, the party will call for universal health care and remaking the justice system. But the platform stays away from goals pushed by progressive Democrats, such as Medicare for All. And it's been called Elon Musk's Moonshot Pay Award, and the Tesla CEO has unlocked the second chunk of it. The electric car maker's average trailing market value over 6 months rose above $150 billion yesterday. That means Musk can exercise stock options that would give him a $2.1 billion profit if he sold. One catch: Musk can't sell the shares for 5 years. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
You see coming, some things you don't. The trick is to be ready for anything. John from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
The Nissan Ariya is the one that represents for the Nissan new chapter. I would say that the Nissan has a great experience because we have 10 years of the history through the Nissan Leaf. We have learned a lot of the voice from the customer.
On behalf of the American people, I want to extend my condolences to the British people from your losses from this preventable pandemic. The CCP's exploitation of this disaster to further its own interests has been disgraceful. Rather than helping the world, General Secretary Xi has shown the world the party's true face.
Tell us what you really think. Secretary Mike Pompeo there on China. He is not shy to tell us what he thinks at all of the Chinese Communist Party. From New York City this morning, good morning. Alongside Tom Keene and Lisa Abramovich, I'm Jonathan Ferro, getting you prepared for the opening bout this Wednesday morning. Here's the price action cross-asset worldwide. Equity futures down just 7. We bounce off the lows. We're down 0.2% on the S&P 500. The bond market with the smallest of bids, a mild move lower, down a single basis point on 10 to break a 60 basis points to 0.59%. But there it is in the FX market. Once again, renewed dollar weakness.
Yeah.
We break down. Euro dollar breaks up. 115.67, up a third of 1% on the session, Tom.
John, I think it's a great data check, but I'm going to take issue with the idea that it's a nuanced move. When you have 4, 5, and 6 days in a row of an additive nuanced move, it really means something. I'm looking at a 0.5872 10-year. Look where gold is, John, this morning. Truly out on a weekly basis, out to record highs. 18.59 an ounce. So for me, John, there's some real movement.
Well, Tom,
here.
you'd have to say it's all aligned as well. The breakdown in real yields in the bond market, the move higher in the gold market. And then we've got the move in the dollar that people have been waiting for. Now, the likes of HSBC are pushing back against this. If you're expecting a broad-based, durable, sustained breakdown in the US dollar, we're going to have something much more nuanced. But you've seen people line up behind that view over the last couple of months, Tom. We're starting to see just a little bit of it. I have no idea where it goes next.
Well, this is the debate that keeps Bloomberg surveillance going on radio and TV, folks. David Bloom, HSBC, saying, maybe not.
I think he called the US dollar a bad hotel. You might not like the food, you might not like the manager, but you've got nowhere else to stay.
George Saravelos moments ago for Deutsche Bank publishing out to a 120 on euro, a much stronger euro. Kevin Cirilli doesn't give a damn about the foreign exchange market. He's our chief Washington correspondent and goes, would you guys get to me and stop yapping about the dollar as well? Kevin, the news flow is extraordinary. I've got to start with China as well. How does tit for tat end?
Well, you've got Secretary of State Mike Pompeo praising the UK. This, as of course, reports circulating that the United States has decided to close some Hong Kong consulates in Texas. It all is part of a broader approach, Tom. And you and I have talked about this before, whether it's the Secretary of State traveling and advising higher education institutions or Silicon Valley in the private sector, or it's formerly DocuSign's Keith Kroc, also at the State Department, trying to rally support across the seas to form an international coalition and a network to combat China's aggressive stance on 5G networks. Or yesterday, John Demers, previously of Boeing, announcing the indictment of 2 alleged Chinese hackers who tried to access COVID-19 research, not just in the private sector here in the United States, but around the world. This is without question an escalation of U.S. foreign policy against China. And I got to be candid here. I think Eli Lake wrote a column about this on the Bloomberg Terminal a couple of weeks ago, and he was spot on about how the change in the U.S. policy, not just the Trump administration, but Democrats and Republicans alike, really recrafting how they deal with Beijing.
I mean, I know that's what John Farrell wants to go to. What's the distinction here between Democrat and Republican responses to tit for tat on consulate closings?
Alliances. Look, when I talk to Democrats, they say that the United States is going to need to restore its footing in the world, especially with Europe, in order to pressure the Chinese to back off on some of their aggressive stances. However, Republicans would say that it is with the aggressive, unpredictable uncertainty that has allowed the United States to continue to be a bit more unpredictable in dealing with Xi Jinping. Now, to their point, if you look at the developments with the United Kingdom and Huawei, for example, they'll point to that as an example of their foreign policy working.
Kevin, let's turn to the fiscal debate and the uncertainty around that. I have to say in the last 24 hours I've been encouraged that the Republicans agree on broad concepts like checks to Americans, like extending the enhanced unemployment benefits. It's all about size, and I think so long as you're negotiating size and not concepts, I can see a path forward. Do you?
Yes, from the standpoint of a timetable, Jonathan, just purely on timetable, Secretary Mnuchin saying after that meeting with Speaker Pelosi yesterday that the timetable they're working on is to get to some type of an agreement by next Friday. Now that quite frankly, I think could run into some political hurdles, especially given how far apart not just the Trump administration is with Democrats, but quite frankly, there's some daylight between the Senate Majority Leader as well as the White House on the issue of the payroll tax. From a matter of policy, there's also this incredible debate about $1 trillion versus $3 trillion. Democrats pushing for a much bigger type of economic stimulus that is needed. But from the issue of politics, and here's where I would pay attention as it relates to 2020, if the payroll tax is not included, as it might not be in the next round of stimulus, expect that debate to come back as we get closer to the election, because there are 50 million Americans who desperately need some type of financial assistance. The Trump administration is pushing this payroll tax cut because they're looking at the middle-class workers who have been able to fortunately keep their jobs, to not go through a furlough, and who are wanting some type of economic relief as well. The administration and Republicans that support this are saying that that could be a smart political calculus, that even if it doesn't get done by the end of the year, could get done in next calendar year.
Kevin, is there enough momentum, enough agreement to get something done by the end of next week when the enhanced unemployment benefits run out?
You know, I'll keep this quick. I'm not sure that, based upon my reporting, I can guarantee that the economic stimulus would come by next Friday. I think that, you know, if you look at Senate Minority Leader Chuck Schumer's comments yesterday, in which he said that the Democratic caucus will hold together, I think you could see some political theater really start to develop sometime coming from Washington over the next couple of days. But ultimately, based upon my reporting, I do think they will reach a deal.
Kevin, great to catch up with you. Bloomberg's Kevin Cerulli down in Washington, D.C. Tom Keene, this is the tragedy of all of this right now. I imagine they're going to make a deal. Might take a couple of weeks. The fact of the matter is, for the people that have depended on that extra unemployment benefit at the end of the week, at the end of the month, it expires, Tom. And for a lot of people facing that uncertainty, that is a terrible position to be in.
Greg Valliere has a working number of 20 million people. John, I think it's one of the greatest miscalculations in modern political era in America. I mean, it's extraordinary. Where will we be in 7 days? I think
the good news, though, Tom, I think we should say this, is that a couple of weeks ago, the Republican Party was talking about actually just letting them expire.
Yes.
Now there's a conversation about
no
tapering
question
them.
about
So I do think we can make an agreement with Democrats and Republicans. It's just the timeliness of it that is really upsetting, Tom.
I think they know the urgency. They're just going through process, but you just have to push the process aside. The criticalness of this into next week, I can't give you the exact date, John, but the immediacy of this is way before August.
Couldn't agree more. Equity futures recover, though. We're down just 5 on the S&P 500, off by not even 0.2 of 1%
for an entry
now.
point.
I'm sure you are. Coming up on this program, Adina Friedman, NASDAQ president and CEO. Next, right here on Bloomberg Surveillance from New York City alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. This is Bloomberg.
opportunity knocks at the door, don't say, blimey, I've still got my pajamas on. Say yes to stuff and it'll take you in interesting places.
We're clearly going through some very unusual times and, enormous difficulties getting groups of people to agree on things.
From Bloomberg's European headquarters in the City of London, join us on Leaders with Lacroix.
True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
From New York City, this is Bloomberg Surveillance for our audience worldwide. We're live on Bloomberg TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. 2 hours away from the opening bell. Here's your price action this Wednesday morning. Good morning to you all. Equity futures bouncing back, down just 0.1% now on the S&P 500, down a little more than 4 points. Earlier on in the session, lower, much lower, off the back of rising tensions between the United States and China. It feels like a throwaway line. It's not. We'll talk about that a little bit more a little bit later. In the bond market, yields come down a single basis point. South of 60, 0.59% is your yield on a US 10-year. But there it is in foreign exchange. Once again, the euro's starting to break out. The dollar's starting to break down. Euro dollar 115.68, up by 1/3%. And Tom, I've got to say, I caught up with Jens Nordvig of Exante Data in the last 24 hours. We both said the same thing. Underwhelmed by the response to what was agreed on the continent in Brussels through the weekend. Yes. I think a massive moment and very little reaction to it over the last couple of days.
The partition is here, bond market, complete non-movement. I mean, I think that's safe to say, but in foreign exchange, it's tangible. As Kit Jukes mentioned, a SocGen this morning, we got quickly to a 115 level. And what I see, John, is people reframing out to a 120. The weak dollar crew is going to Euro 120. We've heard that before. And I would suggest as an amateur, it takes a lot of inertial force in the market to go 115, 16, 17, 18, 19, out to 120. That's a huge mass of movement.
Not just the FX move, though, the bond market move as well, Tom. To see Italian yields on a 10-year still hanging out north of 1% compared to the 35 basis points we are at a 10-year maturity in Spain, that's still a big spread. What we've engineered in Europe is a massive pool of fiscal firepower. They might not use it in a big way anytime soon after their initial disbursement of grants. But, Tom, in the future, we've got another backstop here. We've got the monetary policy one. We've got a new fiscal one. And I think it has to go some way to eroding redenomination risk and reevaluating what a euro is worth.
Well, the FT did a nice treatment on that today of the bonds to come, the debt to come into the market. And the James Athey, who we speak to often on this show, was really quite constructive about the future of actual bond transactions with a united Europe. And that's something new, folks. I think we've been great about, the moment that is. Joining us now, Adina Friedman. She's a NASDAQ president and chief executive officer. Adina, I just saw you on CNBC do the Earnings Act. I want to move on from that. This primal scream I hear right now across global Wall Street is that everything is free. As you well know, in retail, things have run amok. We've got free trades, and all of this trading. There's becoming a new distrust almost of how business is done for retail in America. Are you concerned that retail's getting a fair deal in this new high-speed online economy?
Well, I certainly think that the environment for retail investing has really been pretty great over the last 10 years, frankly. I think that, you know, the fees that retail has had to pay to be able to enter the markets, the democratization of the markets by allowing them to have direct access to the markets over the last 10 to 20 years has really been, you know, a key trend that has driven, I would say, the U.S. markets. But so I do think that's a longer-term trend. The fact that the commissions have gone to free certainly has driven more demand within the retail environment and retail investors coming into the market.
But is it a free lunch? I mean, this is the key thing, and I go back, of course, to our relationship, Adina, with Arthur Levitt and his respect for the individual investor 30 years ago. Is it a free lunch? I mean, if Schwab says it's free, TD Ameritrade says it's free, you can trade NASDAQ shares and it's free. Is it a free lunch?
Well, first of all, it really is free for retail, and I was at NASDAQ with Arthur Levitt during his tenure, and I do think that he really was on a mission to make it so we democratize access to the capital markets, and I think he went a long way in that regard. The online brokers have done an enormous amount to create services that really do benefit retail. And I do think that at the end of the day, they are getting a good experience. The spreads in our markets are extremely narrow, which means they are getting good executions, and they are now not having to pay commissions against and to those retail brokers to gain access to the markets. So for them, it really is free access.
Okay.
Adina, the spreads might be narrow. Are there sufficient protections against losses in companies, say, in China that are filing for IPOs here and trading without necessarily the same types of oversight that U.S. companies face?
Yeah, and that's actually something that we have been in active dialogue with the SEC about. We encourage them to have a roundtable recently with the experts, whether the underwriters, the accounting firms, the lawyers, the SEC itself, and NASDAQ, and all the exchanges. We play a big role together in trying to make sure that we create the right disclosure regime for companies coming to the U.S., and including companies from China. There are some differences in terms of the disclosure obligations that companies have coming from China, as well as some reduced oversight that the SEC has on the accounting firms that support these companies. So that's an area that we are focused on and trying to create positive change. I think the SEC is also focused on it. But that requires some diplomacy between the United States and China, and it's something we've really been encouraging them to really to focus on.
Adina, you've been incredibly proactive about all of this. Can you just walk us through what you have actually done specifically?
Yeah, so we have definitely had some concern that we want to make sure that we can play our role in addressing. So we've increased our oversight of the accounting firms that are being used by the Chinese companies. We normally really rely on the SEC for that, but at the same time, we do want to make sure that we have some oversight over the quality of the accounting firms that are being used. The second thing is we are requiring at least one member of the management team or a consultant to the management team to have U.S. public company experience. And the third thing is we have actually increased the public float requirement for companies that are listing from China. And all of those three things are things that we can achieve, but it's really a broader ecosystem issue that we're trying to make sure that that the government is working with the Chinese government to address.
I mean, the backdrop for this, folks, is really important here. It's the Alibaba and the uproar over Grand Cayman Islands, island positioning, you know, up to years ago, et cetera. But then, Adina, you've got the recent Wirecard train wreck in Germany as well. This is really important. Do you and your other markets, do you feel the SEC is abrogating its duty?
Well, I think that the SEC has an enormous amount of responsibility, and they take it extremely seriously in terms of the disclosure obligations that they place on companies that choose to list in the United States. I do think that they do an excellent job, frankly, of managing those disclosure obligations and reviewing the companies, being very proactive and writing back questions and comments to companies with their filings, and it is a huge part of their role.
But Adina, Ant is doing Shanghai and Hong Kong, I think. I can't remember which markets. They're not doing you, they're not doing NYSE, et cetera. Okay, great. Is that a loss for you? Do you care that you didn't get the Ant IPO?
I think that we should look at the U.S. markets as really the place where any company from around the world would want to come and go public. So I think that we would like to see, you know, every company from around the world choose to list in the United States.
Okay, but then what are you going to do about it? Besides, you know, the president's out there with the politics of the moment, and maybe President Biden, President Trump next term will be the same way. I don't mean to disparage them, but what can you do proactively to maintain America as a place to do capitalism?
Yeah, well, first of all, we are the engine of capitalism here in the United States, and we're really proud of that role. We want to make sure we create a frictionless trading environment, but we also want to make sure we have a really high-quality disclosure regime that we operate under here in the United States. And that's really a combination of the role of the SEC, the role of the exchanges, and the role of the underwriters and accounting firms as they play their part as gatekeepers as well. And I think that that's something that we have to make sure we create that balance, making sure that we have the right kind of quality coming into the United States, but also making the capital markets and maintaining them as open capital markets for the world. It is a fine balance to strike right now.
Adina, have you rejected certain IPOs based on the disclosures, even if the SEC maybe hasn't weighed in?
We definitely have. We go through a second level review, and we do and absolutely reject companies that we don't think meet our standards, even if they've gone through the disclosure process with the SEC.
Adina, fantastic to catch up with you today. Thank you very much for joining us. Adina Friedman there, NASDAQ President and CEO. Tom Keene, a huge issue, and just another dimension to the tension between the United States and China.
Yes.
And on this particular issue, Tom, let's be very, very clear about this. Auditing standards should be the same for every single company listed on the exchange. And Chinese companies should be no different. The fact that this was ever allowed, and for such an extended time as well, is just remarkable to me, finally being addressed, and you can see how proactively the exchanges themselves are working on the issue.
This is a really important issue, John, and just to pause here, this is one of those great surprises when you wander through the CFA curricula, when you realize at some point that there's like 14 sets of rules out there, or 3 sets of rules. And it really, folks, it really, really varies from the United States to how they do business in England, how they do business in Germany, and indeed, John, how they do business in auditing, in measuring the audit across the 4 statements in Asia.
Tom, I'm not here to disparage the SEC, but I do wonder the questions it raises that the exchange has to ramp up its own qualitative assessment of the auditing firms. That's the SEC's role.
I thought Adina was brilliant there on, what they're trying to do, and she's being diplomatic. I get that. She's playing the public officer, but you're dead on, John, about the question of, okay, Ant decided not to come here. What are the ramifications of this in the future?
Well, this is the story, isn't it, Lisa? Are the Chinese companies going to change the way they approach listings in the United States, or will they just stop listing in the United States? And I imagine we'll see a fair bit of the latter.
And also on the SEC point, there's a question of the consistency of the policy, the consistency of the diplomacy. And you heard it in Adina's comments. She's hoping that they can get something together to be able to give some sort of consistent message to businesses. And without that, how much does that uncertainty, John, affect business plans going forward?
Let's get to the price action of the morning, shall we? Good morning to you all. We are -6 on the S&P 500. We're down by 0.2%. In the FX market, we start to see the move in a dollar again. Break down a stronger euro-dollar 115.75. Tom, we pick up another lift up 0.4%. Tom Keene approaching a 116 handle on euro-dollar.
DXY through 95. The world's coming to an end. Finally, a weak dollar's on it. Actually, John, it's a very elegant chart. A log DXY chart has a real thrust to a weaker dollar right now.
You joke, but I'm with you. We're still at 95. And I think this is the point that David Bloom over at HSBC is trying to make here. You can get that rotation back away from the dollar to the euro, to the Aussie, but to have a sustained, durable move in the US dollar, not over a period of a month, but over several years, which is the trade some people are trying to push, Tom, that's a separate argument.
Yeah, it is, no question about it, but we got to admit, John, the weak dollar comes off huge positive news flow out of Europe, and that's going to last for only a while.
Maybe. Turning to the earnings, coming up a little bit later, Microsoft after the close, including Tesla. We've heard from some of the airlines. Up next on this program, Joseph Donardi, Stifel Airlines analyst from New York City this morning. Good morning. Heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. Another sign of the worsening relations between the U.S. and China. The U.S. has ordered the Chinese consulate in Houston to be closed, according to the State Department. It's to protect Americans' intellectual property and private information. China calls the move an unprecedented escalation, and it's threatening to retaliate. Last night, Houston firefighters went to the consulate after reports that documents were being burnt in outside containers. President Trump is warning that coronavirus pandemic will probably get worse before it gets better, and he urged Americans to wear masks. The president resumed daily virus briefings 3 months after he abandoned them. Polls show more of the public blames him for failing to control the outbreak. President Trump speaks today on what he calls combating violent crime in American cities. His push for federal agents in cities hit by protests and spikes in crime is a policy that appeals to his base. Mayors around the country warn they'll resist if the president sends agents to their cities, as he has to Portland, Oregon. And U.S. health officials have agreed on an order for 300 million doses of a coronavirus vaccine. It's being developed by Pfizer and BioNTech. The companies won't actually be paid until there is an FDA approval or authorization for the vaccine. President Trump reportedly asked the U.S. ambassador to Britain to help get the British Open golf tournament played at his course in Scotland. According to the New York Times, the president asked Woody Johnson to see if the British government could steer the government to the Trump-Turnberry resort. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rich Gupta. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy.
When everything around us, including the way we work and live, has been interrupted, uninterrupted service is peace of mind. Juzi from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
I am David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
probably, unfortunately, get worse before it gets better. Something I don't like saying about things, but that's the way it is. We are imploring young Americans to avoid packed bars and other crowded indoor gatherings. Be safe and be smart.
There is a shift from the President of the United States from New York City this morning. Good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Tom Keene, we got a scent of this in the last couple of days. The Republicans are starting to panic about November. We saw it with Senator Ted Cruz of Texas, worried about Texas getting flipped and going blue. We're seeing it in the administration as well, quite clearly urging the president to make a change in approach. Seeing him stand there alone, trying to control the message, the story of the last 24 hours.
Well, 103 days to the election, and John, I'll be honest, day 99 is a big deal. It's a shift traditionally before the two conventions, traditionally for that quiet for a vice president and a presidential nominee to regroup and move forward, and then the dash across October. John, all of that is blown up this year.
In a big, big way, Lisa Abramowitz, and isn't that the story going into November? These polls matter. The president over the weekend said these polls were fake polls. The way they've responded coming into this week tells me that these polls are loud and clear for this administration.
The question is, how will it be received by Republicans that have largely eschewed mask wearing in tandem with President Trump? Will people start to wear masks? Will they continue to support President Trump if he shifts his stance? And I'm looking at the polls to see what the case is there, John.
That's going to be the story next couple of days, Tom, how the polls start to turn in response to a president taking the center stage again at 5 p.m. Eastern on a regular basis.
It will be the news flow, and I would note that it was a short press conference last night. Maybe that will continue. Right now, on the wearing of masks, and it is nowhere more sensitive than in the compressed cabins of our airlines. Joseph DeNardi is at Stifel, and what he's done differently here is he actually has buys on the airlines. That would be the love of Southwest and also, I believe, Delta as well. Joe DeNardi, are you bottom picking there? How do you, I know you got holds on others, and maybe you've got sells you don't want to talk about, but how do you construct a buy off a company in an industry fighting for its life?
Yeah, I think you need to have some confidence that demand for air travel is going to return at some point, and that there will be additional consolidation in the industry, and that will produce increased earnings power from the survivors and the airlines that are in a position to play offense at some point. And underlying all of that, underlying our buy ratings are, there's work we've done related to how much money airlines make selling miles to credit card companies, and that portion of the business is substantially more durable than kind of the core airline business.
Joe, this word survive.
There's real value there longer term. Obviously, we need people to travel, but there's tremendous value there. And United validated that with the debt raise that they did a little while ago, where the credit markets essentially valued their loyalty program at $20 to $25 billion. There's an asset there that's still underappreciated by the market if folks can have any confidence around what the value of the core airline business is.
Joe, United used that word survive, positioned to survive. That was the CEO, Scott Kirby, in the release after the bow yesterday. To survive, who needs a dance partner and who can fly solo?
Yeah, I think this is an industry that has wanted to consolidate further. It's very capital intensive. I think the public perception is that it's not particularly competitive because there are fewer airlines now than there were 10 years ago, but the remaining airlines are all larger. And so on average, the number of airlines operating per route is the same now roughly as it was 15 years ago. And so I think that the industry wants to consolidate. The DOJ has kind of been the limiting factor there. And so I think Southwest would love to strengthen their presence on the West Coast with Alaska. And there would be a number of airlines, Delta, United, the top two, that would be interested in JetBlue. And so I think if that happens, that the earnings power that would produce would help to offset the kind of the structural impact from business and corporate traffic being lower for a period of time.
Joseph, does anyone go bankrupt? And I'm thinking of American Airlines in particular, which has had a little bit more difficult of a time raising money.
Yeah, that all depends on the pace at which demand recovers or does not recover. And then it comes down to how deep of a hole Americans willing to dig to avoid bankruptcy. American has access to significant capital, probably another $10 billion, more than $10 billion, via financing their loyalty program. It depends how much of that they want to do, and at what point the board would say we could raise additional capital, but it would put us at such a competitive disadvantage on the other side of this that it's not worth it.
Well, Joseph,
so I think
hold on a second.
that's the decision ahead of running out of access to capital.
That's a key question facing a lot of the airlines. At what point are these debt raises not worth it? They've raised billions and billions of dollars into an environment of slowing growth. At what point will this become a huge liability for their business plans after the pandemic?
Yeah, it's a very good question. I think we're nearing that point. To this point, the cost of that capital has been relatively reasonable. Obviously, American had a pretty expensive debt raise, but again, if demand comes back, they can pay that back relatively quickly. The question becomes, for American, financing the loyalty program can get very expensive, and that comes down to they would go to Citi and offer Citi a very significant discount, the price at which Citi would buy the miles that Citi needs to buy over the next few years to front American cash. That's what airlines have done historically to avoid bankruptcy. It's a very, very expensive, punitive way to finance the airline. And so I think if demand doesn't come back in fourth quarter or goes away again like it did in second quarter as the virus comes back or does not, I think that's really going to be kind of the inflection point.
Joseph, thank you. Appreciate your time this morning. Joseph Donati there, Stifel Airlines analyst. Tomorrow, before the opening bell, we will get numbers from American Airlines. Tom Keene, an industry in some real pain. The mission to survive, that was the mission in Q2, and arguably going into Q3, Q4, Tom. That is still the objective for many of these companies, to try and get through it.
I didn't get this with Mr. Donati, but John, the money question here is the vector of the airlines is really a non-industry until about 10 years ago. And frankly, the vector's been very, very good over the last 10 years, a responsible industry. To get off the mat now, what do they go back to? That responsible industry? Or is it, once again, an industry of chaos?
They've got to adapt, Tom, the business model entirely. If business travel doesn't recover, and many people think it won't for a long, long time, that's been subsidized in the back of the airplane, especially transatlantic. What do? They've got to make massive changes.
We need to start the surveillance mandate right now. Bring back the 747.
You want to start flying?
Bring back
just
the
you on a 747.
Yes.
That's going to be an expensive flight, Tom. Up next on the program, Scott Wren, Wells Fargo Investment Institute Senior Global Market Strategist from New York City this morning. Good morning. This is Bloomberg Surveillance.
the Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
This was that crisis, and that's what we delivered with a 15+% ROE. So I think it validates the strategy, but it's our strategy. It's not for everybody. This is what we chose. We didn't want to be credit heavy. We want to be flow-based, fee-based, asset-based.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
Fiscal stimulus is great, and it kind of gives us that shot in the arm and it buys us time to get there, but we think that markets are going to be increasingly focused on actually identifying a solution here in the months to come.
There's going to be a lot more unemployment coming, and certainly a shift from what was temporary unemployment into permanent.
Confidence is the elusive issue here, and in an environment where unemployment is going up, and for those that are in work, there will be that fear of the specter of unemployment.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. An exceptionally busy day here at Bloomberg Surveillance. Lots to talk about on the news front. Stimulus in Washington or non-stimulus. The breaking news on China. Markets moving as well. We'll do markets here in a bit with futures -7, NASDAQ positive. But the dollar moments ago breaks down to new weakness off DXY. That's that blended index of major trading partners. Bloomberg Dollar Index showing ever weaker index. These are markets on the move, and that'll be one of our themes across the hour. There is a theme of Washington and stimulus. Our Kevin Sir really reports of deeply divided Republicans. And then John Farrow, there are fire trucks in Houston.
And they are united on one thing in Washington. It's how to deal with China. Houston and the consulate, the Chinese consulate, shutting down after a U.S. request. I should rephrase, a U.S. demand. Tom, we have woken up so many times over the last couple of months to that headline, rising U.S.-China tensions. And once again, we wake up to it once again. And guess what, Tom? Once again, this equity market gaps lower, then shrugs it off. Equity futures almost unchanged on the day off the back of this.
No question, the resiliency of the market tangible. I would note gold, $18.63 an ounce, up $19, breaks out to a recent high here. On a weekly basis, gold is at a record high. Lisa, the bond market is not just full faith in credit. What are the dynamics you've seen in high yield in IG?
Actually, if you take a look at high yield bond spreads today, you can see that they've shrunk dramatically, with all-in yields at the lowest since early February, 0.6% off their all-time low. I do think there's an interesting dynamic here, Tom, where you've got the Fed put on one side, and then you have the economic put, this feeling that perhaps the wish to keep the economy going on both the U.S. and the China side will offset some of these tensions from bleeding over too much. A big question, though, going forward.
We're looking at bonds, the commodity market, and particularly gold. Oil elevated as well, but it does come back to the equity market, and so much of that is what to do next. For the people that have been on board this huge move off of March, and for the thousands of people, retail and institutional, that are behind. Someone that's been dealing with this for years is Scott Wren with A.G. Edwards years ago, and now with the Wells Fargo Investment Institute. Mr. Wren has decades of experience, is saying you got to have courage to be in this market, and he joins us right now. Scott Wren, where's the courage right now?
Well, Tom, I think you have to have the courage to believe that we're going to see some medical advancements. We're going to see some better employment. We're going to see confidence leading to consumer spending slowly coming back over time. Not that you can expect S&P earnings to be back to those 2019 levels, next year, but at least it's somewhere on the horizon, and I think the market's confident, are certainly acting as though we're going to continue to get some good news here.
Scott, where does a weaker dollar fit into your thinking this morning?
Well, John, I think that really, if you look at the DXY, it's really not that much change from where it was a couple of years ago, but certainly the stimulus that the Eurozone's putting together, the relative growth, which in my mind, when you have inflation virtually at zero, it's all about growth and relative growth. And European growth didn't look very good. Global growth starting to look a little bit better than it was relative to the U.S., and I think that's the main reason that we've seen the DXY drop a little bit.
So, Scott, this is a really important dimension, whether the U.S. versus rest of the world growth story is getting more compelling for an allocation to the rest of the world. Is that the story for you?
Well, for us right now, I mean, we've been debating this in the Investment Strategy Committee for some time. We've been underweight both EM and developed markets. So, that's a consideration. We certainly think that growth might be a little bit better than what we thought. So, we may do something there to adjust. But basically, right now, we're focused on U.S. large cap growth. That's where we want to be. Technology is the sector we like the best. So I think right now that's worked out for us, and we continue to like that position, at least at the moment.
How much does your big tech bet rely on a Fed put ongoing?
Well, Lisa, I think, for better or worse, I think that does exist. What I fear is that, in the future, every little stumble in the economy where normally excesses would get washed out are no longer allowed to happen, and the Fed, just drops interest rates to zero, every time. But certainly, the market's pretty confident that the Fed puts there. I think that's a rational argument, and we're in a low interest rate environment that's going to last for an extended period of time.
So you don't think that perhaps the Fed put is overpriced, as some people are saying? I mean, Pete Scheer was on here yesterday, and he was saying that perhaps people have overplayed the Fed influence, given the fact that their balance sheets actually stayed flat over the past month or so.
Yeah, I mean, you could certainly make that argument, but for us, that's an important factor. I'm a big believer in not fighting the Fed. If we do see a stumble here in the economy and the trajectory looks like it's not going to be in the right direction at the right slope, the Fed's going to do more. They certainly have some more ammunition, and they're not going to hesitate. I think the market's pretty convinced that that's the case, and that's the right way to think of it.
Ex-pandemic, Scott, you are acclaimed for going across this nation, talking to financial advisors and talking to institutions and retail who aren't participating. How do you catch up now?
Well, I tell you, Tom, there is a lot of people who haven't participated.
Exactly.
Retail investors, they're sitting on a lot of cash. They're very nervous. They can have all the plans, and we can talk to them and say, you need to step in here all day long. But, the way the market's moved lately in these 1,000-point days, which we haven't had in a while, and you get a, big drop quickly, people are afraid.
Oh, come on, Scott.
I think there's a lot of pessimism. That's one reason why we're up here, Tom, is, you look at the level of pessimism out there. It is high.
Okay, but Scott, come on. Scott, you and I go back to Phil Correa at Pioneer 1 million years ago. There used to be a pat answer, your dollar cost average in. Baloney. Everybody's behind in their actuarial assumption of their retirement plan. People are scared stiff. What is the mechanism you use to participate in a market that is 6 big tech stocks?
Well, that, and one good thing is, we've seen the S&P equal weight do better relative to the S&P 500. So the breadth is a little bit wider. But that's the thing, Tom, is you have to talk about what's going to happen. That's why we have year-end 2021 targets out there, because we want our clients to look beyond the end of this year. We see an attractive return out there. We see the economy coming back, growing 3% next year. That's the kind of situation where you just have to hammer home the message. What sectors are going to benefit? This is why we think we're going to see, the Fed continue to be easy on rates. We're going to see some global growth. You have to try to work it through the fundamentals, because the stocks have run. You look at it relative to this year's earnings, and stocks are certainly not cheap. They're not cheap really relative to next year earnings, but they're not extremely overvalued. So they're probably fair value right now. If you want to put money in the market, maybe you put a third of your amount in now at fair value, but you have to be ready to pull the trigger and step in on pullbacks, bad weeks, bad days, those
Scott,
kinds of things.
How do the rising tensions between the U.S. and China fit into that message?
You know, I think, Lisa, it is kind of odd that, typically the market would be quite nervous about that. Clearly, we're not seeing that right now. But trade tensions, if we filter into this trade tension story, the market's focused on the virus and employment right now. But certainly as we get down the road, trade tensions are going to have an effect. So right now I'm a little surprised that we're not seeing more volatility related to China. But, if these do accelerate, I don't think the administration is going to push it too hard. We're going to see some volatility. But that's probably, depending on what happens with the election, that's a 2021 story.
Scott, did you ever think you'd have a 10-minute interview taking the tone you're taking with a NASDAQ 100 up north of 20% year to date?
Yeah, John, I tell you, it's the NASDAQ has obviously been on an incredible tear here. And, when you look and you're saying, wow, we're 47% off the intraday low on March 23rd, where there's a lot of uncertainty out there. I mean, it makes sense that the market's up, but I have to admit, we're right where we think we're going to be at year end. So this has been a bigger rally, quicker than we ever expected.
Hey, Scott, great to catch up with you, sir. Scott Wren of Wells Fargo Investment Institute. Tom, we're talking about being scared and afraid. The NASDAQ's up 26% in 3 months.
I mean, granted, there's a pandemic involved, but what we heard from Liz Ann Saunders the other day, what we hear from Mr. Wren, these are people with decades of experience, John. They got their ear to the rail, and they hear it out there. People are petrified, even as, 7, 8 stocks go up. I mean, what's SPX X these 7 or 8 stocks? I don't know what that number is. But as Scott Wren says there, a huge number of people have missed this surge.
Well, I can tell you for the NASDAQ 100, about 3 stocks make up about a third of that overall index, Tom. That gives you a sense of how much of the heavy lifting is being done by just a handful of names. To get to the broader market, risk on rotation here, really giving this FX market a lift against the US dollar. It's not just a euro move, and I want to emphasize that. We unlocked some euro strength yesterday with that deal, but top of the pile is the Aussie dollar, and that speaks to that risk on rotation, Tom. That proxy for growth, that proxy for risk, the Aussie dollar outperforms.
With sterling at 127, can you get those top seats this year?
I would love to, Tom. I'd love to say that we could go and watch a football match next season. I've got no idea if we can, but I have no idea also what cable was doing approaching 130 seemingly over the last couple of days at 127. Bottom of the pile this morning. That speaks to the nervousness around that. Can you see the pound really stretching out ahead of a Brexit debate that still has not been resolved? I can't, can you?
No, well, Sir Ian was on earlier, and he made clear the body language this weekend of this EU summit really changed the Brexit debate.
Coming up on this program, we won't talk Brexit. I promise. Up next, Greg Peters, PGIM Fixed Income Head of Multi-Sector and Strategy from New York City this morning. Good morning. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. China calls it an unprecedented escalation. The U.S. has ordered the Chinese consulate in Houston to be closed. According to the State Department, it's to protect American intellectual property and Americans' private information. Beijing has warned that it will retaliate. Last night, Houston firefighters went to the consulate after reports that documents were being burnt in outside containers. President Trump has rebooted the coronavirus briefings with a shift in tone and a warning. He was notably more reserved than in the past. He encouraged Americans to wear masks and avoid risky behavior. The president promised that the virus will be defeated, but he said it probably will get worse before it gets better. Republicans putting together a coronavirus relief plan broadly support the idea of more stimulus checks to individuals, but they're expressing doubts about President Trump's call for a payroll tax cut. The differences between Republican senators and the White House threaten to push any action on the stimulus into next month. And the Democratic Party platform is sticking close to Joe Biden's line on major policies. According to a draft of the document, the party will call for universal health care and remaking the justice system, but the platform stays away from goals pushed by progressive Democrats, such as Medicare for all. And it's been called Elon Musk's Moonshot Pay Award, and the Tesla CEO has unlocked the second chunk of it. The electric car maker's average trailing market value over 6 months rose above $150 billion yesterday. That means Musk can exercise stock options that would give him a $2.1 billion profit if he sold. One catch, though: Musk can't sell the shares for 5 years. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
You see coming, some things you don't. The trick is to be ready for anything. Pablo from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
The national security bill was passed by Chinese lawmakers. The Hong Kong police force has already acted in accordance with the new law.
It's a very disturbing development.
This is, in effect, an attempt to end one country, two systems.
The central government is telling us just stay out of politics.
Does, as you say, have some catching up to do on that front. So we are expecting to see a little bit of strength coming through at the start of trade. How long will it last, though? The perennial question.
I think we need some really better fundamentals. Until then, I do think this, stay-at-home tech story, secular growth in a low-rate environment will continue to perform, and we'll continue to see buyers on dips.
Mona Mahajan there of Allianz ahead of some big earnings later after the closing bell. You will hear from Microsoft and Tesla. From New York City this morning, good morning. Alongside Tom Keene and Lisa Abramovich, I'm Jonathan Ferro. Your price action shaping up as follows here in New York, around about 1 hour and 12 minutes away from the opening bell. Equity futures down just 4, negative a little more than 0.1%. Talked a lot about that bond market. Yields in a single basis point to 0.59%. The euro unleashed in the last 24 hours off the back of that agreement in Brussels. Euro dollar 115.78. We advanced towards 116. More broadly, dollar weakness with an Aussie dollar very much top of the pile in G10. Headline crossing the Bloomberg terminal, Tom Keene. It comes from Senator Rubio, who says on China that China's Houston consulate is a massive spy center. That coming from Senator Marco Rubio. China's Houston consulate is a massive spy center. For our audience just tuning in, China has been ordered by the United States to close down that consulate in Houston, Texas, Tom.
Yeah, what's interesting in this, and I go to the Washington Post article, Ellen Nakashima from a couple days ago, John, is it's not just one case or one idea of espionage. It is a whole series of documented proceedings, some that get to court, some that do not get to court, that have led to the tone that you hear from the senator from Florida.
Tit for tat. You just wonder how the Chinese respond. Yeah. Remember, there's 5 consulates here for the Chinese in the United States, 5 consulates for the United States in China. If one closes down here, Tom, I imagine that one is going to close down also for the United States in China. Those kind of incremental moves won't disrupt financial markets too much, but I think be aware, incrementally every single day, every week, every month, we take another step away apart between the Chinese and the United States. And one day, Tom, you wake up to something that is irreparable.
Right.
And I think that's the direction of travel at the moment.
Part of the theme of Richard Haas's The World, my book of the summer, John, and this is something that Ambassador Haas really emphasizes as well. They give out a lot of blue ribbons, you know, T-ball, maybe Pee-wee hockey. They give out a lot of blue ribbons in finance, and you go, yeah, okay, big deal, so what? And then there are awards that really matter. One of the most coveted and most difficult awards is the Morningstar Fixed Income Manager of the Year Award. I can tell you, folks, it is incredibly difficult to take that trophy. Mr. Peters has taken it a few years ago. Greg Peters is with PGIM and knows a thing or two about the fixed income market. Greg, let me start out with a general question. How does our audience on radio and TV, how do they buy fixed income now with these very, very low yields? It truly seems priced to perfection.
Yeah, thanks, Tom. I would say people have been saying that for quite some time now, haven't they?
Yep.
It's continued to work out. So the way we're looking at it at PGIM is that we actually see a lot of value in fixed income. So you're in a backdrop where growth will remain rather muted. Obviously, it's going to come off the bottom here, post global lockdown. You have inflation that is basically really difficult to find. And then you have credit spreads that are actually quite wide relative to their own history. So I evaluate the global fixed income market, and I'm actually pretty excited about the opportunity over the next 6 months to several years.
Greg, you've got to be the first guest in the last month that has come on and talked about fixed income and credit and said, I'm excited and there's value. Help us find that value right now, Greg.
Yeah, so I would say it's important to remember that it's about the destination. And so corporations have actually suffered here, obviously, in the first quarter. You're seeing that through the cash flow and earnings. Leverage, as a consequence, has moved up. We've seen a tremendous amount of issuance, but they're keeping cash on balance sheet. So it's somewhat perverse in a way, but they've actually made a more stable balance sheet and more liquid. At the same time, what you're seeing now is corporate management teams that are looking to delever. They're looking to preserve free cash flow. They're cutting back dividends. They're pulling back on share buybacks. These are all attributes that favor fixed income investors.
Hold on a second, Greg.
I think that's really important. Yeah.
Is that actually deleveraging or is that survival? It's two different things. If you cut back on dividends and share buybacks because you need the money to keep your lights on because you're getting no revenue, that's very different than saying you're actually going to cut debt.
Well, it's, it all helps the bondholder, right? So the irony, Lisa, is that when things are going really well, when the economy is booming and companies are spending hand over fist through share buybacks, they're actually trashing their balance sheet, and the leverage is increasing, and that's not such a great investment for fixed income credit investors. At the same time, spreads are wide, right? So you're getting paid for that risk, and you're getting paid to take that chance that companies will continue to delever. And so that's kind of my firm belief here.
Greg, what I hear from you is that you think the C-suite is going to be doing their job for the bond market and not the equity market for the coming year or so. With that in mind, help us get specific here. Rating, sector. I know you can't talk about single names, but give us some direction here, Greg, where you look and where you don't go.
Yeah, so for me, the real opportunity is in the space that I call the crossover credit corridor. And that is the triple B companies and investment grade corporates and the double B companies in high yield. And so if you just look at that relative relationship, so triple Bs are in like the 85th percentile of cheapness relative to single A's going back to 1994. It's basically the same thing for double Bs relative to triple B. So it's in the 85th percentile as well. So the inherent cheapness is in this crossover corridor, fallen angels. That's where the opportunity is. That's where my focus is. And I think that's where you're going to be most rewarded over the next several years or so.
And that's where the sweet spot has been over the last several months off the wides of March as well. Greg, fantastic to catch up with you, sir. Greg Peters of PGIM. My best to you, yours, and the whole of the team over at PGIM. Joining us on this program to talk fixed income and credit. Tom Keene, let's talk about China. A headline that came out from Reuters a couple of hours ago, actually, indicating that China is considering the closure of a U.S. consulate in Wuhan, one of the 5 consulates that the United States has over in China. This is the tit for tat I think we can expect now, Tom.
Yeah, we've kept quiet on this, folks. A headline and just a little blast on Twitter. That's not good enough for Bloomberg surveillance. But now we have language not only from Reuters, but from Bloomberg News as well. John, let me quote it quickly. China could respond to the American order by closing the U.S. consulate in Wuhan, where the virus originated, or another city, the Bloomberg source said. So we're getting some more formal language within the reporting and the chaos out of China.
Hard to keep up, isn't it, Tom?
Yes.
Last couple of weeks, South China Sea, diplomacy spilling into consulates here in the United States over in Houston. What next? TikTok. That is becoming a big focus as well, Tom. The social media aspect and how many people in America are on that app, on that Chinese-owned app,
John,
Tom. And what happens next? And I know there's going to be some kind of story with you and your family and how you'd love to see this app banned.
I would like to see this thing go. Not only do I have, John, not only do I have the offspring on TikTok, vet bills on TikTok as well.
Lisa's living it too.
Oh, yeah.
Believe me.
Everybody is. Anyone with a child under the age of 10 is intimately familiar with
Alongside
TikTok.
Tom Keene and Lisa Abramovich, I'm Jonathan Ferro. Up next, we'll catch up with Enda Curran on this story. And after that, we'll catch up with Michael Zezas, Morgan Stanley head of U.S. Public Policy Research. From New York, this is Bloomberg.
Greatest fear is if we continue with a system that allows pharmaceutical companies all the monopoly control over the medical solutions to this pandemic, that we're going to see a situation of a bidding war, essentially, between rich countries.
I
I can't block the U.S. from doing deals. Of course, I would imagine many allies would be quite unhappy at the time if they're dying, their populations are infected, and that's not being shared. So what we can do is create legal agreements with companies and try to move forward. If at the end of the day, those legal agreements are broken, or countries seize assets or don't allow provision of vaccines, that's a problem.
We'll have to find a solution because some of these arrangements have been made. And I think we have to be pragmatic about it. I think we also have to stick to our guns.
Some things you see coming, some things you don't. The trick is to be ready for anything. John from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
Inflation goal is symmetric, which means we should overshoot it. We're having a difficult time doing that, like all developed economies. I'm supportive of the idea of letting inflation get above 2% before we take any action with respect to the Fed funds rate.
From New York City, this is Bloomberg Surveillance for our audience worldwide. We are live on Bloomberg TV and radio alongside Tom Keene and Lisa Abramovich. I'm Jonathan Ferro. Around about 60 minutes until the opening bell. The cash open around the corner. Here's the price action so far this Wednesday morning. We gap lower on equity futures off the back of a headline that China has been ordered to close a consulate over in Houston. The United States making that order. The tit for tat very much in focus. We bounce off the lows though. We're down just 4 points on the S&P 500. A little more than 0.1%. In the bond market, yields in a single basis point. Your 10-year yield 0.59%. Story of the morning, story of the last 24 hours in financial markets, though, has got to be the move in foreign exchange. The dollar breaking down as this session grows older. This dollar gets weaker. Euro dollar out to 115.84, up 0.5%, approaching that 116 handle. And the Aussie dollar on top, Tom, up 0.66%. And that move top of the pile speaks to that risk-on rotation in the currency market that you're seeing into the commodity currencies, into the growth proxies. That's what's playing out in the FX market, Tom Keene.
Well, there's no question about that, John. And, of course, this is a Euro-centric move in the dollar. Euro stronger than yen. That's what the pros follow as well. A headline right now from the Secretary of State traveling in Europe, Chinese Communist Party, it is a threat to freedom everywhere. That the kind of message that we've heard from the Secretary of State through the last 2 or 3 days of his travels. Right now we travel to Hong Kong and to Garden Road. That is a beautiful and historic road with St. John's Church in Hong Kong, the ancient church of the Anglican faith. And right near it, the American consulate. Enda Curran is our chief Asia economics correspondent, and he is considering the consulate services in Hong Kong or in Wuhan this morning. And what was the level of surprise in Hong Kong, and your measured guess at the level of surprise in Beijing to this news from Houston?
I think a lot of surprise, Tom. I think it underscores there is no floor currently in relations between China and the U.S. The language that came out of Beijing hinted at their anger. They said it was outrageous, unjustified, erroneous. They've promised to respond. And they said, of course, specifically that infiltration and interference is never in the genes or tradition of China's foreign policy, without being more specific. So the language coming back from Beijing hinted they were caught off guard, but they certainly have promised that they will respond in kind.
And how do you frame this for market participants this morning? Because this market does not know what to do with any of this. We had it the other week with the South China Sea. We have it this morning with the consulate in Houston. They just feel like incremental moves that nobody knows what to do with. How do you frame it?
Well, it's Hong Kong, it's Huawei. It's Chinese reporters based in the US, it's trade, it's social media, it's Xinjiang, it's travel, it's the South China Sea. The list continues, Jonathan. As I said at the start, it doesn't feel like there's any floor in this relationship at the moment. We continue to hit new lows. It's obviously very rare for any country to shut down a consulate of a foreign power in its way, and I think it just underscores that the risk dynamic between these two powers is quite fluid now and very volatile, and will remain so, I think, until the election. There is a view out in this part of the world that perhaps the election in the US proves to be some kind of a circuit breaker, regardless who wins, some kind of a reset. Not a complete reset. There's a bipartisan approach in the US, we know that, but there's a view out here that this relationship will continue to deteriorate until we get clarity on who's going to win the US election.
I just wonder how misplaced that view is. And appreciate your time. I know you're up late in the evening, so we always enjoy catching up with you. Thanks for staying up. Enda Curran there, Bloomberg Chief Asia Economics Correspondent. Tom, there is always a level of mistrust between two countries. There's certainly always going to be a level of mistrust between the Chinese and the United States. What I think is interesting about this moment is just how publicly this is all playing out on a weekly basis. And there are certain actors at the forefront of all of this. Secretary Mike Pompeo, just one of them.
Well, you know, I'll go back to the point you said before, John. It goes on until it stops, and then something new happens, and that's a huge mystery and leads to the uncertainty that we see right now. And, of course, uncertainty is something that the market doesn't like. Again, stocks remarkably stable. I would note Euro made a dash for 116 and did not get there. Right now, this is a wonderful person to talk to about the ballet in Washington that we see on the future of this economic slowdown and the burden on state and localities. Michael Zezas does public policy for Morgan Stanley, but he does it through a wonderful prism of municipal credit. It really helps to be a credit analyst before you spout about public policy. Michael, thrilled to have you on. Let's start with the desperation. How desperate are states and locals to this aid? How bad do they need it?
They need it pretty badly, but not nearly as badly as they would have if the Fed hadn't come through with the municipal liquidity facility, the MLF. So by our estimate, state and local government, state deficits through the end of fiscal 2021 range anywhere from 180 billion to 375 billion. And the Fed's MLF backstop is making roughly $250 billion available for states. So in theory, before you undertake any austerity measures, you could basically punt most of that budget deficit. You could term it out about 3 years just with the MLF. But the austerity in itself is important, right? Because if you do have to undertake that austerity or that borrowing, you probably see credit downgrades. You see a drag on the broader macroeconomy through state and local government layoffs. So it's obviously much better for investors if CARES 2, what Congress is negotiating right now, put something like $250 to $500 billion in state and local aid into the bill, and actually that's where we think they're going to end up. So I think at the end of the day, a few weeks from now, you're going to see this problem, I don't want to say solved, but largely mitigated, kind of taking the state of state credit back to where it was in January, February of this year.
So in other words, a $250 to $500 billion allocation to states and municipalities in the next round of the CARES Act will be sufficient to totally offset the damage from the pandemic to state finances. Is that what you're saying?
Yeah, I think that's more or less correct, right? And totally offset is probably too strong of a word, but you largely fill in that gap. Now, of course, if we're wrong in our own estimate about how the rest of the pandemic plays out, if the vaccines don't get us to herd immunity by the first half of next year, then you'd expect a continuation of revenue shortfalls, furthering pressuring budgets. But if we are comfortable with the assumption, and we are at Morgan Stanley, that you're going to be able to achieve that by the first half of next year, then yes, this is a substantial mitigant to the stress that's opened up for state and local finances.
Michael, let's get to the substance of the current debate down in Washington, D.C. There seems to be a general broad agreement on sending more stimulus checks to Americans, on extending the enhanced unemployment benefits to some degree at least. Where's the big sticking point that you expect to emerge in the coming week of negotiations?
Yeah, I'd say there's a few different sticking points. One is on the absolute size. but Republicans seem keen to want to keep that headline number relatively low to appease some of the deficit hawks in their caucus. The marker they've laid down is we don't want to see more than $1 trillion. I think practically speaking, there's a good chance that that number is going to have to come up a little bit to accommodate what everyone wants, right? If we filter this down to what's bipartisan, what addresses the pandemic impact directly, and what are things that can be done without impacting the budget baseline over the long term, it's still a filter that allows for things like you mentioned, stimulus checks, state and local government aid, an extension of supplemental unemployment benefits, and therefore $1 trillion probably looks more like the floor of what's going to happen here. So they think that seems like a red line, but it's going to have to move a little bit. The size of the extra unemployment checks it seems like a red line, but it's probably going to have to move a little bit. I think ultimately there's enough agreement around those issues in principle that we're pretty confident you're going to see an agreement here over the next 2 to 3 weeks.
Tom, I think this is the really important aspect of this, that the concepts themselves aren't really being debated. It's about size. If they were negotiating the concepts themselves and had broad disagreements over them, I think it would be difficult to get a deal and get a deal quickly. We actually saw this in Europe, a very similar story. The Netherlands weren't debating the concept, they were debating the size. And when you see that playing out in negotiations, I think you can be confident that we can come to a deal. Someone needs to come down a bit, someone needs to come up a bit, we meet somewhere in the middle. If it was about concepts, I'd be much more nervous.
I would agree with that, John, but I think there's a huge difference between Europe and America. And Michael, this goes to the labor component of our municipal finance. Do you just presume layoffs at the federal, at the state, and at the many cities level?
Well, I think there is probably going to be some degree of that, and it tends to sort of, at least at the state and local level, it tends to kind of lag the real economy. Now, I think if we get the appropriation that we think you're going to get, those layoffs become a much lighter touch. But yeah, I mean, I think you can't dismiss the idea that there wouldn't be any layoffs whatsoever, but this is really about mitigating that effect and the drag on the state and local sector on the broader economic recovery over time. I think that's heavily influencing the debate in Washington, D.C. You have plenty of Republicans who are very reticent initially to extend any aid to state and local governments, right? You had Mitch McConnell talking about bankruptcy as a solution. But what seems to have crept in is that there are plenty of Republican states that had big budget gaps, not just because of COVID, but because of oil prices going down. And there's an understanding that the sort of negative feedback loop on the economy keeps going if you don't fill in some of these budget gaps.
Some of the more toxic language just isn't a part of the conversation right now. Michael Zezas, great to catch up with you, sir. Morgan Stanley's head of U.S. public policy research. And Tom, there's a reason for that. A couple of months ago, when the states needed aid, it was the blue states. And now it's all states, including the red states across the Sun Belt, that are suffering.
Oh, there's no question about that, John. I'm glad you bring that up. That has been the profound shift. I really looked carefully at the stats today on deaths, John. It's amazing the success of, just as one example, New York, front and center, blue state weeks ago, I should say. Boy, have they brought down their statistics. They are dramatically better now than what you see in the red states.
And they made some very big mistakes early on that they had to correct. And I think we're all hoping that we can see the same course taken across the Sun Belt as well. Coming up on this program, on gold, on oil, Francisco Blanch of Bank of America Global Research. Looking forward to that conversation from New York City this morning. Good morning to you all. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Your equity market recovers just a little bit off the lows. We're down 7 points on the S&P 500, negative 0.2%. In the FX market, the dollar breaking down, the euro breaking out. Euro dollar up 0.6%. Top of the pile, the Aussie dollar, the risk on rotation reflected in foreign exchange this Wednesday morning. This is Bloomberg Surveillance.
With the First Word News, I'm Ritika Gupta. Another sign of the worsening relations between the US and China. The US has ordered the Chinese consulate in Houston to be closed. According to the State Department, it's to protect Americans' intellectual property and private information. China calls the move an unprecedented escalation, and it's threatening to retaliate. Last night, Houston firefighters went to the consulate after reports that documents were being burnt in outside containers. President Trump is warning that coronavirus pandemic will probably get worse before it gets better, and he urged Americans to wear masks. The president resumed the daily virus briefings 3 months after he abandoned them. Polls show more of the public blames him for failing to control the outbreak. President Trump speaks today on what he calls combating violent crime in American cities. His push for federal agents in cities hit by protests and spikes in crime is a policy that appeals to his base. Mayors around the country warn they'll resist if the president sends agents to their cities, as he has to Portland, Oregon. And President Trump reportedly asked the U.S. ambassador to Britain to help get the British Open golf tournament played at his course in Scotland. According to the New York Times, the president asked Woody Johnson to see if the British government could steer the tournament to the Trump Turnberry resort. Johnson's aide warned the move would be unethical. The Times says the ambassador raised the issue anyway, but failed. And sales of New York's most expensive homes plunged by 70% in the first half of the year. That was the biggest decline amongst the world's priciest cities. According to broker Knight Frank, just 41 properties sold for $10 million or more. That's down from 137 a year earlier. London was right behind with a 68% drop. Global News, 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
When opportunity knocks at the door, don't say, blimey, I've still got my pajamas on. Say yes to stuff and it will take you interesting places.
We're clearly going through some very unusual times and, enormous difficulties getting groups of people to agree on things.
From Bloomberg's European headquarters in the City of London, join us on Leaders with LACWA.
That over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
When everything around us, including the way we work and live, has been interrupted, uninterrupted service is peace of mind. Juicy from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
markets were falling for everything but those big tech stocks, people just plowed into the big tech stocks. Now with the economy coming back, those earnings for those other companies are doing a bit better. So I don't think it's an either or. I think it's a both and. You've got to pick your name.
Bob Dollar Nuveen ahead of some big earnings later this afternoon after the closing bell in New York for big tech, including Microsoft and Tesla. From New York this morning, good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Tom Keene, euro dollar breaking out close to a 116 handle, a 115.92. Up next on Bloomberg TV, I'll be stepping away to catch up with Matt Hornbag of Morgan Stanley, who is looking for a much, much weaker dollar.
Well, you may get a 0.57 handle on the 10-year yield, John, as well, but on the weak dollar, folks, it's real simple. There's a persistent deterioration this morning led by euro. Euro-yen clearly indicates stronger euro versus yen, with the euro dominant. And just for a second here, just for a little bit, we had a 116 on euro dollar. Right now, on the gyrations of the commodity space, and it is a deceptive space. The Bloomberg Commodity Index is actually really good math, and it's about 18% gold. And with gold to the moon, clearly that index has done better. But what about the rest of the space? Francisco Blanch is head of global commodities and derivatives and owns gold up to his eyeballs. He's like Goldfinger in the early Bond movie, and he joins us this morning as well. Francisco Blanch, let's get gold out of the way here. Is it dominating all of commodity analysis right now? Are the indexes no good just because of gold?
Tom, you make me laugh. Look, I mean, we are having all precious metals ripping here, but also, frankly, we've had a pretty good run on industrial metals. And then the one commodity that hasn't moved all that much has been oil, which has been pretty stable around the $40-$45 level for a few weeks now. But yes, there's a lot of focus on precious metals, but also a lot of focus on what China is going to do next in terms of infrastructure and the big pull from China from a resources perspective. So I think you can there's a reflation story going on, and obviously gold is the biggest beneficiary because of a lot of macro factors that have been piling up to support it, right? So I don't think it's the only story in commodities. I also think that industrial metals are picking up, and oil is kind of on waiting on the sidelines until we get a bigger uptake in economic activity. That's, I think, the reality for oil. COVID
Francisco,
is a crisis.
Hold on a second there, because there's a sweet spot between industrial metals and precious metals, and that is silver, which is on a tear. How much do you see that escalating at this point? Can you give us some calls both on silver and gold in the upcoming months?
So we've maintained a $25 target on silver. I mean, obviously, one of the things that silver is good for is solar panels. And what we are saying is that a large portion of all this money going into infrastructure is going into what some people label the energy transition. And that energy transition means we're going to be using a lot more silver for a lot of this uses. The same thing applies to copper, by the way. So think about the energy transition metals, what we call the MIFTs, the metals in future energy technologies, copper, lithium, cobalt, silver itself. So silver is getting very hot partly because of that. It's a combination, and it's also some people put it as a poor man's gold. I mean, it's something a little easier to buy. But I mean, I don't quite buy that argument. But I think there's certainly that accelerating trend on silver. I also think both platinum and palladium, particularly platinum, has a long way to go here as well.
So
we
Francisco,
are bullish across the board.
We should say that Tom has been outfitting his entire apartment in solar panels, so he's been contributing to the rise in silver. There's a question of whether the industrial metals can continue to rally in tandem with weakening oil, the idea that you could have demand for building, but not necessarily a commensurate demand for crude. Could you see that happening?
It's happening to some extent, right? Because as we said, a lot of the infrastructure packages that are coming through, and like I said, particularly China, I think are going to boost that kind of spending. But COVID is primarily a mobility crisis. The more we move, the more COVID spreads, and that's I think a fact that hopefully has been shown in different ways now. So my sense is that until we have a vaccine or a cure or a combination of both, we're going to have to keep limiting our mobility. And that's not great for oil. We still think that demand will be 98 million barrels a day for next year on average. But again, it should have been 103. So we're going to be maybe 5 or 6 million barrels a day away from the level of demand that we should have seen next year, other things being equal.
Francisco, what is the instability to EM here, to commodity EM? How close are we to where your world folds over into the fiscal world of these EM nations?
So, I mean, I think if you look at Russia, Russia is in reasonable economic shape. Their budget break-even is in the mid-40s for oil. So with crude oil having rallied back into the $43, $45 range, they're in reasonable shape. Other emerging markets, not so much. Remember, countries like Saudi Arabia have a much higher break-even, so they're going to struggle more. And then other countries which are heavily reliant on things like iron ore or agricultural commodities like Brazil are in better shape because, as you know, iron ore has been one of the stellar commodities in the past year. So iron ore is really ripped here, so that's kind of benefiting Brazil as well. So I think for the most part, it's oil nations, and it's those oil nations that have not adjusted their budgets. And Saudi Arabia comes up probably at the front, but also many others in Africa and Venezuela, obviously, and what have you.
Too short a visit. Francisco Blanch, thank you so much, with Bank of America, of course, on commodities. Lisa, just a really extraordinary and nuanced tape right now as we go into the morning here, 35 minutes away from the opening trading. The equity market, I really can't tell much, but it is extraordinary how rapid we've moved to a 116 euro.
I will say the nuance tape is a very good way of putting it. This idea of dollar weakness just deepening as euro gains more traction. Interesting to see that you're also seeing yields come in. I'm looking right now at a 10-year yield, 0.584%. That is basically 4 basis points from the all-time low, Tom. And this comes as U.S. deficit widens. You have to wonder, with the idea of people selling the dollar and the U.S. selling more debt, at what point do yields start to rise?
I think it's mostly about aggregate demand. I mean, the greater story here, I mean, the tensions with China are tangible today, folks, but really so much of this is this mystery of the use of stimulus in Europe and getting to a new stimulus in the United States. And again, the calendar is absolutely critical here, this July 22nd. Curve flattening here in the last hour or so. I'm not going to go into the details right now. I'll let all of our different platforms do that here in the next hour, but clearly with the lower yields has come that flattening coming in, which can show economic slowdown. Much more to talk about this morning. Again, the dollar, I guess, is just front and center. 115.99 on euro. Good morning. This is Bloomberg. Coming up, Bill Ackman.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
None of us are safe until all of us are safe. We need to have a global approach into handling and fighting COVID-19, a global pandemic. Part of this, of course, finding an effective vaccine.
Sense of the real-time action, the 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
From New York City, for our viewers worldwide, good morning, good morning. The countdown to the open starts right now with 30 minutes until the opening bell. With equity futures recovering, we begin with the big issue. Republicans struggling to reach an agreement on the details of another stimulus plan. Senate Majority Leader Mitch McConnell weighing in.
I'm going to introduce a bill in the next few days that is a starting place, that enjoys fairly significant support among Republican senators, probably not everyone.
President Donald Trump demanding a payroll tax holiday, meeting resistance within his own party. South Dakota's John Thune remaining skeptical, saying, quote, if it's a choice between doing checks and a payroll tax cut, I think it's pretty clear the checks actually have a more direct benefit for the economy. For more, let's bring in Kevin Cirilli, Bloomberg chief, Washington correspondent. First of all, Kevin, it's the negotiations within the party and then with the other party. How are the first set of negotiations going?
Well, look, in terms of President Trump trying to sell the payroll tax cut to Republicans, this is what you have to remember. This is a political long game and a calculation by many Republicans who have wanted to see the payroll tax cut come to fruition for quite some time. This is their opening bid. Even if it were to fail between now and the fall, it will likely be a cause that other Republicans take up and maybe possibly this administration, if they get a second term, in 2021. Because for the millions of Americans who have been furloughed or laid off, people like Senator John Thune are saying that the targeted stimulus needs to be like a microscope in terms of really selecting and identifying who needs the economic relief immediately and how to get it to them. And they believe that the checks is the best way to do that. But there's this other argument that the people who have been able to hold on to their jobs, people who have avoided being furloughed, that they should get some economic relief as well. And that's the opening bid that's coming from President Trump. One other quick point that I would note here, this is this tax credit for businesses who have avoided furloughing individuals. Jonathan, every day we're talking about the bevy of headlines coming across the Bloomberg terminal, which say essentially that companies are bracing for more furloughs and layoffs by the end of the year. This stimulus, from a conservative standpoint, could provide the opportunity to prevent those layoffs by the holiday season.
Kevin, there's bad news here and there's good news. The bad news is that they've waited so long to even have this conversation. The good news for me is that they are debating size, they are not debating concepts. More broadly, there seems to be agreement on what we need here on both sides. Is that the takeaway for you too, Kevin?
Absolutely. And look, I mean, you know, when the European Union's passing a stimulus and we saw the market reaction just within the last 24 hours on those developments, there is an expectation that Washington, D.C. will get its act together and pass this. And when I spoke yesterday with several staffers, all of them said, look, there's likely going to be some political theater, likely going to be some folks digging in, but similar to a government shutdown, ultimately this will get done.
Kevin Cirilli, looking forward to getting it done down in Washington, D.C. Terry Haynes of Pangea Policy weighing in on the negotiations, writing the following. Liability reform is the linchpin to the bill. Republicans drawing a red line think it's essential to the economy. Democrats prefer national standards. There's a compromise there, but the issue will be one of the big cliffhangers. Terry Haynes joins us now. Terry, walk me through that. You think this is going to be the issue that holds things up in the next couple of weeks. What's the compromise?
Well, I think the compromise, frankly, John, is a little bit of both. I think what you end up with is Democrats reluctantly agreeing to get some liability reforms passed in exchange for more money for state and local governments, that sort of thing, their priorities. And in return, there's some national standards that get put in place to provide people with a baseline. To my mind, politically, these concepts are being pushed by different sides, but they're not completely incompatible. So I think at the end of the day, some compromise on that is reached that allows everybody to move forward. But that'll be a lot of the theater over the last week or so of all this.
Terry, looking at the situation going forward from here, this payroll tax cut looks like a non-starter from my perspective. Is that yours too?
It is. It's. I've never really thought it is. It has any traction. The president talks about it off and on, and with different degrees of support. I don't see anybody on Capitol Hill that's willing to fall on their swords over it, and fundamentally that's why I think it doesn't happen. I subscribe to Kevin's view there a minute ago. If it's a failure, it's an opening bid for next year.
I thought that we would have more resistance over extending enhanced unemployment benefits. That's not the sense I get from the conversation at the moment, Terry. I imagine they want to taper them a little bit. How do you think the compromise evolves in the coming weeks on the size of those enhanced unemployment benefits?
Well, firstly, I think it's a little bit under what it is right now. I think that's very important to understand. There is a consensus, to some degree, a silent consensus, but a consensus that the current levels were disincentives for people going back to work, and that's key. I think it's a combination of two things: either extended unemployment benefits with a little bit of a haircut, or on the other hand, an idea that Democratic Senator Ron Wyden has been pushing, which is basically kind of a stair-step approach. As the unemployment rate continues to go down, so do the benefits. And there may be some combination there on that. You've got Senator Portman of Ohio and Ron Wyden, trying to work something out on this. And I think those are two very good guys to forge a compromise.
Terry, Secretary Mnuchin did so much over the previous few months to bring the two sides together. He really led the debate over stimulus. Who's leading now?
Well, I think Mnuchin still is, but I think it's important to understand that, and he's negotiating with the House, of course, on the side. But I think McConnell is. McConnell's been working very hard and has been very transparent about pushing forward to try to get a consensus product out of the Senate with as much consensus as possible, and then doing what the Senate always does, which is tries to impose its will on the House as far as the art of the possible goes. And as far as the number goes, which I agree with the prior discussion of this. As far as the number goes, I mean, the number is likely to be somewhere around $1.5 trillion, not just because that's the political and policy possible, as I've been saying for quite some time, but also you had Obama CEA head Furman on your air Monday saying he thought that was what was economically necessary. And when you've got the policy, political, and economic all moving together, you're building a consensus.
Terry, did you sense that something has changed this week from the Republicans, from this administration? We heard from Senator Cruz earlier in the week, who's really worried about Texas getting flipped and turning blue. Then we saw the president alone there in that news conference at 5 p.m. Eastern yesterday, addressing the people of America, trying to take back control and control the message. Do you sense that shift as well?
What I sense is election year politics and people trying to play whack-a-mole with different problems. I don't think there's any real chance for Texas to go blue in any meaningful sense, whether it be presidential election or congressional delegations. But on the other hand, it behooves Senator Cruz to be careful about that sort of stuff. And, as far as the masking goes, I think the White House is bowing to reality. I mean, the consensus in the public is that we ought to do everything possible, including wearing masks. So, it doesn't behoove him any longer to put up much of a resistance on that, while at the same time saying people should be free to do what they want.
Terry, for the President of the United States, for some people, for many people, he has not taken this seriously enough. Do you think the polls are about to change just to see him standing there at 5 p.m. Eastern on a daily basis, seemingly taking it more seriously?
I think on balance, it helps him a little bit. It exposes him to different kinds of peril, but I think it helps him. But, what I've said to you before, and I'll say it again because, the news outlets like the Washington Post are starting to say this. Don't look at the current Biden-Trump polls as meaningful. They are either adult polls or registered voters. Registered voters are at most 70% of the population. And then you look, depending on the states, you can get down on likely voters to, half or so of that. So the polls are already starting to tighten some. I won't bother you with the details there. And they will tighten even further as we get down to who's actually voting. And we're still 3+ months away.
Well, you can bother me with the details of that another time. I do want to finish on something that polls very, very well with this electorate, Democrats and Republicans, and that's the current stance of this administration on China and the Chinese Communist Party, and a more aggressive stance. Secretary Mike Pompeo very much at the front center of this, Terry, and I'm just wondering how we should frame what is happening right now down in Houston, Texas, with the United States ordering the Chinese Communist Party to close down that consulate there. This market, I think, does not know what to do with this because when it was trade, we could see it was tariffs. We knew what that meant for the economy, for markets. No one knows what to do with this, the South China Sea, and these incremental events that bubble up week after week. What should we be looking at, Terry?
I'll say two things about that. One is that it is a canard to suggest that China policy is somehow partisan or that it will change much should Vice President Biden become president. There is no greater bipartisanship on any issue than on China. Secondly, I think what you are looking at is a variety of areas where the U.S. and China are in competition and sending messages to each other. But fundamentally, that has not meant the rupture of the relationship. The Phase 1 trade deal continues to move along in some respects, despite all the other heightened tensions that are going on, whether it be with the consulates, whether it be with Hong Kong, whether it be the South China Sea sovereignty issues. As long as, it is one of your British prime ministers or foreign ministers that used to say that they have Britain has no fixed positions, only interests. It's in the U.S. interest and the Chinese interest to continue to trade. As long as it is in their mutual interest, I think they probably continue to do that regardless of the tit for tat here.
It's in our interest to get you back soon. Terry, great to catch up with you, sir. Terry Haynes there of Pangea Policy. Coming up on this program on the equity market and the tension between the United States and China. We'll catch up with Kate Moore, BlackRock Global Allocation Head of Thematic Strategy. That conversation just around the corner. In the equity market, we gap lower a couple of hours ago. As the session grows older, we come back. Equity futures down just 3, -0.1%. This is Bloomberg TV.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They move the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
China steals intellectual property and research which bolsters its economy. And then they use that illicit gain as a weapon to silence any country that would dare challenge their illegal actions. This type of economic coercion is not what we expect from a trusted world leader. It is what we expect from an organized criminal syndicate.
Strong words from the Deputy Director of the FBI as the United States accuses China of sponsoring criminal hackers targeting coronavirus vaccine research. This as the U.S. orders the closure of the Chinese consulate in Houston. Joining us now is Bloomberg's Michael McKee. Good morning to you, Mike. Another crack in this relationship.
Another crack, John. Diplomatic analysts call it a serious escalation as U.S.-China relations continue to deteriorate. The administration giving the Chinese 3 days to close their consulate in Houston. Smoke rising from that consulate yesterday as Chinese diplomats began burning papers. Now, the U.S. did not cite a specific reason for doing this. However, they did say the move was to, quote, protect American intellectual property and Americans' private information. A State Department spokesman who declined to be named says China has increased the scale of spying and influence operations, including interference in domestic politics, stolen intellectual property, coercion of business leaders, and threatening the families of Chinese Americans in China. This morning, Florida Senator Marco Rubio tweeted that the Houston consulate is a massive spy center. The Chinese say they are going to retaliate, and the question for markets is, what do? They say they will react with firm countermeasures. China strongly condemns such an outrageous and unjustified move, it said, which will sabotage U.S.-China relations. The question is, what do? Do they close a U.S. consulate? There are 6 in China. Or do they escalate? And what effect that would have on markets? One fear is they could close the U.S. consulate in Hong Kong, which would be seen as an escalation because so many Americans live there. You mentioned, John, the market reaction to this. Not only have equity futures and bonds reacted, but we're seeing the yuan move lower, get weaker on the day, and soybean futures have dropped. Of course, raising questions about whether the Chinese will follow through with that so-called phase 1 trade deal.
It seems to me that so long as the trade story is not harmed by this, that somehow market participants will just brush it off. Michael McKee, great to catch up with you, sir. Headwinds piling up into the second half. Kate Moore of BlackRock weighing in on the risk to markets, saying the following: the ongoing global recovery will likely be uneven. The second half of 20 brings growing U.S. election risk and uncertainty, including interpreting Democratic policy priorities, persistent China tensions, and the ongoing policy response to the growth disruption. Kate Moore, I'm pleased to say, joins us now. Kate, just quickly on the China issue, the takeaway for many people, overwhelmingly the consensus view, is that so long as this tension does not bleed into trade, it doesn't matter to us in financial markets. Is that a bad take?
You know, I think each incremental move and kind of decoupling between the U.S. and China is hard to really price into markets. But one thing we know for certain, and I know some of your previous guests and Michael was just mentioning a moment ago, is that we have moved from a period of strategic cooperation with China to a period of significant strategic competition. That's on every front. It's around technology, it's around cyber, it's around access to the virus, remedies, whether that's a therapeutic or a vaccine. And we expect this decoupling to accelerate over coming years, regardless of which party takes control of the White House and overall D.C. in January of 2021. So what do markets do about that? I think that there are still opportunities to invest specifically in Chinese domestic plays that are less, perhaps sensitive to some of the trade issues and that are really geared towards the Chinese consumer, which is still putting up really good numbers. But we have to be thoughtful about the companies that rely on huge amounts of sales from China, whether or not they, reshore their supply chains or reduce their exposure to that market. So this is something analysts are going to be watching very closely.
Okay, we often talk about risk around this story. Let's talk about opportunity. There is a belief that the world breaks into 2 spheres of influence, with China and the United States at the epicenter of either. China quite clearly is choosing national tech champions. Is there an opportunity there for a foreign investor?
Look, I don't want to sound a little Pollyanna here, but yes, there's absolutely opportunity for global investors. As we separate supply chains around 5G and around technology, we're going to see both in the U.S. and in China smaller companies, parts of the supply chain, components manufacturers, service providers actually grow in size and import for the specific end market that they're serving. So in my view, there's two ways to kind of approach this. You can say, I'm not going to touch anything in China, or you can take advantage of this decoupling and invest in parallel technology systems in the U.S. and in China.
Kate, the additional story, the structurally impaired constituents that you think we should avoid right now off the back of this pandemic. Can you walk us through that and why you think that's the biggest concern, the biggest reason why you don't expect a big value rebound?
Yeah, you know, every time we have a small rotation in the market, you see more domestically oriented plays, some of the small and mid caps do well, stuff that falls into deeper value, you know, perform, especially relative to the high-flying tech companies. Everyone is calling for a significant value rotation. But John, you and I both know that in order for value, as it has traditionally been characterized, to significantly and persistently outperform, you need a big acceleration in the economic activity. And we're just not expecting that in the near term. I mentioned a couple of times that I think the economic path is going to be quite uneven. And I actually think that some of the stuff that falls into the value bucket is structurally impaired. There are parts of the resource sectors, in particular energy, that don't look very attractive to us. And there are parts of stuff that is very well owned, that is trading at premium multiples in technology and in consumer, that we think deserves those multiples. Because even in a weaker economic environment, these companies are putting up revenue growth. And that is a critical component, I think, when we're looking for quality and sustainability.
So, Kate, I respect that you can't do single names, but give us the playbook, the guidebook for identifying the value traps and the value opportunities.
Yeah, I think as we've thought about opportunities in cyclicals and in things that are priced at a discount, let's say, to the technology and consumer names, we want to stay in higher quality companies. We've called that sometimes wimpy cyclicals, but we do have exposure to parts of the industrial complex and some selected parts of resources globally that we think will do well. But as I was mentioning, energy is a place we just don't want to take additional risk. And I think you have to be selective around the banks. You know, financials play a part in value indices and into some of this sort of rotation trade. But I would say, you know, in that space, we want to own the higher quality banks that have the greatest exposure to the higher quality consumers and the lowest probability of taking on huge amounts of credit loss.
Okay, there's something we keep coming back to, and this conversation keeps taking me there. It's something you've said repeatedly, that the composition of this recovery is more important than the shape of this recovery. Why is that the case, Kate?
Because, you know, what we've seen with the pandemic and the sort of response to COVID-19 has been an acceleration, or a word that I keep using, maybe it's a little bit nerdy, supercharging of existing trends. And that's around how we consume, how we spend money, how we spend our time, what services are priorities for us. And, you know, many of these trends were in place at the end of 2019 in January, February, but we have sort of shifted both on a corporate and a consumer level to really focus on the most efficient means to consume both products and services. And I think this environment is giving us an opportunity to put even more money behind those companies that provide those products and services. So it's not so much that we're going to go back to the previous 2019 economy or 2018 economy, but the compositional change, I think, is where we're seeing the greatest opportunities. And again, a lot of that's around tech, parts of the consumer, just-in-time delivery, and services that meet our new, at least for now, work from home, and in the future, partially remote working environment.
Okay, always enjoy catching up with you. Send my best to the team at BlackRock, won't you?
Good to talk to you, John.
Okay, thank you. Kay Moore of BlackRock, head of thematic strategy. Coming up on the program, the analyst action you need to know. That'll be next in our morning calls. And later, Microsoft reporting after the closing bell. You'll hear from Tesla too. Mark Lehman, JMP Securities president, will be joining us to preview a big 2 weeks for tech earnings. In your equity market this morning, good morning to you all. We recover a little bit. We're down 7 on the S&P. We're negative 0.2%. You're watching Bloomberg TV.
downtown Mexico City, where there's quite a lot more movement than before because the downtown is beginning to reopen. Some businesses are still shut down and others are open, so they're alternating days of the week in which they can open. There are a lot of people wearing masks, almost everyone is. The city also tried implementing a rule that would limit the flow of people to downtown. Mexicans are being very cautious.
Three-day winning streak on the S&P 500 coming into Wednesday this morning. Equity futures backtracking just a little bit. We're down 7 on the S&P. We're negative 0.2%. Later, big afternoon for earnings stateside. Let's get you some morning calls. A look at some of the analyst recommendations on Wall Street this morning. We begin first up with UBS downgrading Macy's to a sell, a $3 price target. The analysts expecting the rapid shift to online shopping to persist well after the pandemic ends, leading to widespread store closures. This was something Kate Moore of BlackRock was just giving a little bit of a nod to. That stock is down a little more than 3% going into the opening bell. Your second call comes from the team at Morgan Stanley, upgrading Coca-Cola to overweight, $54 price target. The analyst citing the stock's recent underperformance and outsized valuation discount compared to its peers. We're firmer there by 0.6%. And your third and final call, it comes from the team at Guggenheim, downgrading Snap to neutral following quarterly results. The analyst citing management's cautious tone and slowing growth in daily active users. That stock is down by almost 7% in early trading. The opening bell is just around the corner ahead of a big evening for tech. We'll catch up with Mark Lehman of JMP Securities with equity futures right now negative just 6 points. We're down 0.2%. This is Bloomberg.
Nissan Ariya is the one that represents for the Nissan new chapter. I would say that the Nissan has a great experience because we have 10 years of the history through the Nissan Leaf. We have learned a lot of the voice from the customer.
Europe does, as you say, have some catching up to do on that front. So we are expecting to see a little bit of strength coming through at the start of trade. How long will it last, though? The perennial question.
Senator Rubio thinks we can get a relief package done before the August break. That's the focus down in Washington. From New York this morning, good morning. Going into the opening bout with equity futures declining just 5 points on the S&P. We're down a little more than 1/10%. On the S&P, on the NASDAQ, by not even 1/10. There's your opening bout. Switch up the board in the bond market. Ahead of some important earnings later on this evening. Yields come in 2 basis points to 0.58%. Story cross-asset worldwide for me in the last 24 hours. The breakout in the euro, the breakdown in the US dollar more broadly. Euro dollar taking a little look at 116 and coming back down to 115.87. Your outperformance through much of the morning has been with the Aussie dollar. It is about the euro right now. The euro firmer by 0.5%. That's your cross-asset price action. Let's get to the market desk, shall we? Here's Abigail Doolittle.
John, lots of big earnings movers to take a look at today and movers on other news as well. In fact, let's start out with the shares of Pfizer. The pharma stock is popping higher, actually off of the pre-market highs, but nonetheless a little bit higher, up 0.5 or 0.5%. This, of course, as the U.S. has ordered 100 million doses of Pfizer and BioNTech's vaccine, locking in to secure in case of a shortage before it even exists. So we have this race for the vaccine, and we also have a race to lock in supplies of it. Biogen, the biotech giant, earlier had been higher, now lower. They put up a beat and boost quarter. The quarter had been helped out by demand for the company's MS drug. At this point, lower. We'll be reporting on that as the day goes on. United Airlines all over the map. At this point, lower. The good news, they did beat revenues by 16% to put up almost $1.5 billion. In other news, 6,000 workers will exit. That should lower the cash burn, and they've expanded wearing face masks to lounges in the airports. And then finally, Snap, well off the lows from yesterday in the after hours. They, of course, missed daily user targets for the second quarter, held off on a forecast. The company saying that events that drive use of their Snap application, sports and movies and the like, that because they've been on hold, there's just too much uncertainty. So you see those shares are lower, John.
Abigail, thank you. 1:45 into the session this Wednesday. Here's your equity market, unchanged on the S&P to -0.1%. We are positive 1/10 on the NASDAQ, ahead of a big afternoon for tech earnings. Emily Rowland of John Hancock Investment Management weighing in on the tech space, saying earnings season has been tipping the scales.
Tech stocks are really priced for perfection in this environment, and you can see that as far as some of the earnings results that we've seen so far in terms of growth names that had priced in, possibly unrealistic expectations. And even though they're doing well, their stocks have been punished.
Emily Rowland there. Let's head to the market desk on this story, shall we, and bring in Bloomberg's Kelly Lyons. Hey, Kaylee.
Hey, John. Well, I think Emily said it best. Tech stocks are priced to perfection. Since the lows in March, the tech-heavy NASDAQ Composite Index is up 56% from those lows, sitting right around record highs. And that has actually brought the market cap of that index alone to be greater than that of the entire MSCI All-World Index x the U.S. That is how dominant tech stocks are in this market. And if we had time, John, I would show you a chart that just 4 stocks, Apple, Amazon, Alphabet, and Microsoft, together are larger than the entire Japanese stock market. I promise it exists, and that fact is true, John. And it is just those 4 names, along with Facebook, that make up a whopping 23% of the weight in the S&P 500. That is how concentrated and top-heavy this market has become. The rally in those stocks, of course, really what carried us off the bottom, but it's that same rally that has brought their valuations to incredibly rich levels, all trading around 30 times earning. For Microsoft, that multiple is actually more like 36. So expectations are high as we await these second quarter results, John. Of course, we get them from Microsoft after the close today. We're closely watching Tesla as well, because talk about a lofty valuation. Also, will it turn a profit and make it into the S&P 500? That's the key question. And then as we move on later into next week, we'll get Twitter, Facebook, and the trifecta of Alphabet, Apple, and Amazon next Friday. And they really have to rise to the occasion here, John. Over the past 3 months, analysts have raised their top and bottom line targets for tech by 24 and 20 basis points, respectively. They're expected to see profit fall just 9.4% year on year relative to the 44% plunge we're expecting for the broader market. market. But as our very own Gina Martin-Adams over at Bloomberg Intelligence points out, their outlooks have to impress too. In her view, if the guidance coming from tech fails to substantiate a robust top-line recovery, there could be downside to come after the rally we've seen, John.
Kelly Lyons, thank you. Thank you very much. Let's continue this conversation with Mark Lehman at JMP Securities, raising some concerns about the tech rally, writing, quote, high valuations and concentration of gains in a few stocks is never a good sign. That being said, the best stocks benefiting from working from home and the new economy are those names: Microsoft, Google, Amazon, and Netflix. They did get hurt after a tough quarter, so that seems rational. Mark Lehman joins us right now. Hey, Mark, what is rational and what is irrational?
Well, rational is you're putting money to work in places where you are spending a lot of your time and a lot of your dollars. And also, when you see a quarter like Netflix had after the ascent they had, the stock got punished, and that's a good sign. I think you're going to continue to see these stocks be in the news because more and more of our dollars and more of our eyeballs are spent here. And the question is, what are we willing to pay for that? And like I said, and you quoted, concentration in a very few names has been a harbinger of things that are not great for the market. But these are the best companies, and I see nothing getting in their way in the near term that will change that except for valuation and perception.
Well, Mark, let's explore that further then, because that is always the takeaway consensus view, that narrow breadth builds a shallow foundation, a fragile foundation for a market rally. But for these names, and Jonathan Golub at Credit Suisse did some work on this in the last couple of days, the top 5 represent north of 20% on the S&P. We know that. And there are some parallels going back to March 2000 for the previous top 5 back in that particular era. But the current top 5, and this is Jonathan Golub's point, Mark, capture a greater percentage of the market earnings. These companies, Mark, they make real money, don't they?
Well, they do, and you look at what happened in 2000 and look at what's ironic to me, of course, is the leaders at the time, except for Microsoft, which I call the only tech stock that's really reinvented itself besides Apple. You look at the leaders in 2000, they failed to really look at the future and see what was going to take our economy forward. And I think these companies have innovated to such great extent. You look at the way Amazon has created and recreated and tried and succeeded in many, many ways, but it failed as many ways as that. But they keep innovating, and they keep touching more and more of our wallet. And to call these companies tech companies and just tech companies, I think is a fool's errand, because Amazon used to be a consumer company, but it's getting into payment processing, it's getting into cloud computing, it's obviously a consumer company, and you can look across the spectrum at what these companies do, and to categorize these as just tech companies is obviously not relevant. But what I think you have to pay attention to is where are these companies spending more of their wallet, where are the consumers spending more of their wallet, and it continues to be in the names that we're talking about.
Well, let's talk about the 2 names that you really like. One is Amazon, the other is Facebook. And quite clearly, there's one company there with revenue streams coming off the back of a huge secular shift. There's another company that I think should be very, very cyclically exposed. That company's Facebook, Mark. Surely they're about to see some revenue decline. I've kept saying that. They keep telling us that might happen. Are you expecting to see it this year?
Well, we've talked about it, and clearly they've got some work to do with their advertisers, and that's tempered a little bit by the last month, but we've seen some of them flee the platform, and that has definitely been something that clearly Mark Zuckerberg, who's probably as mercantile a CEO as I've seen, is paying attention to. Those names that are leaving the platform appear to have abated in the last couple weeks. We'll see when they put up their quarter what they're saying. I still think going into an election season, it is such an important platform for people, and how much time they're going to spend on it going into this election is crucial. And I think the advertisers and obviously the electorate is going to pay attention here. So I think we're going to learn a lot after they report. But again, I think they've got some issues. They feel a little bit tempered with numbers of people fleeing, and we're going to learn a lot when they report their second quarter coming up.
We also might learn a lot on the US-China trade front, Mark. The tension there is pretty evident again this morning. Mark, there's a feeling for some people that it's a matter of time before TikTok gets banned. How much of a win would that be for Facebook?
Well, I think it'd be huge, and I think this president and this administration is standing up to China right now. And look, the market's not panicking today. I think if you would have put this headline up a year ago and said, we're going to kick the Chinese out of their Houston consulate, wow, that would have been a headline that probably took the market down. But more and more we're seeing opportunities for Americans putting manufacturing here, standing up to Chinese rhetoric. And I think that's an incredible story today that's being masked by a market that's gone up, or frankly, it's not gone down today. A year ago, this probably would have hurt the market a lot more than it is today. I'm impressed with that kind of resilience. What we also haven't talked about is on the vaccine and the virus front, and rapid testing that I think is going to be ubiquitous going into the fall is going to really help prop up the market, and the awful numbers that we.
I'm placing a new order for British pound. It's a long at 1.27. So new order placed for British pound against US dollar at 1.27.
Here is Abigail Doolittle.
John, let's start out with the big one, and that is Tesla. Shares are popping higher, and of course, the electric vehicle company reports today after the bell. This stock, John, on the year, up more than 275%. So, of course, we already know that they beat the second quarter delivery estimates. The question is, will they put up a profit for a fourth quarter in a row, and what does the future look like? Options suggest a 15% move up or down. It's hard to see another 15% up, but it is Tesla, who knows, beyond price to perfection. It's almost parabolically rich. Turning to First Energy, this stock is plunging again. Once a moment ago had been halted for trading volatility in a bear market this week, down sharply in a bear market today, in fact, but down about 15% into today. This, of course, on a bribery charge today. Lots of downgrades on the street. Turning back to a winner, Navient, the student loan company, they beat core second quarter estimates. The CEO said the quarter's exceptional results have to do with the company's high quality loans and also the rate environment. And then finally, Best Buy has been all over the map, but right now popping higher. They missed the June quarter estimates, but they're saying things have started to look up in June. And of course, it seems that they right now are getting that pandemic pass as investors and traders look forward to a possible recovery. John?
Abigail, thank you. We'll touch base with you a little bit later in the program. Coming up on this show, the euro breaking out as the dollar breaks down. We have a 116 print on euro dollar just moments ago, 115.94. Up next on a weaker dollar story, Matt Hornback and Morgan Stanley, the head of global macro strategy from New York City this morning. You're watching Bloomberg TV.
You see coming, some things you don't. The trick is to be ready for anything. Pablo from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
13 minutes into the session in New York City, we advance top of the pile, healthcare and tech, up a little more than 1/10 on the S&P, the Nasdaq up by 0.2%. Turning to the Fed now, where the Senate Banking Committee advancing Fed nominations for Judy Shelton and Chris Waller, despite criticism that Shelton's controversial views will jeopardize Fed independence. Senator Sherrod Brown expressing his disagreement.
When we have no leadership from our president, and the Federal Reserve Chair is one of the only leaders trying to guide our recovery, putting one of the president's close advisors on the Fed board will only make things worse. The last thing we need right now is more price volatility and instability that will only end up hurting working families and businesses more. That's why independence matters.
Joining us now, Michael McKee, Bloomberg International Economics and Policy Correspondent. Mike, many people thought this wouldn't get past the Senate Banking Committee. It has. Will it get past the Senate?
Looks like it will, John. There are 3 charges against Judy Shelton, and you heard the senator talking about them there. The first is that she is an advocate for the gold standard. The second is that she is intellectually inconsistent. She changed her views on rates and inflation when it appeared they would harm her chances of getting confirmed. And third, as Sherrod Brown said, she's seen as an advocate for Donald Trump's interests rather than the economy as a whole. Nevertheless, Republicans made their peace with that and advanced her nomination out of committee. And when and if Mitch McConnell schedules a floor vote, she is expected to be confirmed, which changes the question from whether she'll be on the Fed to what she would do there. And the consensus is not much. She'll be one of just 12 voters, and so won't have very much influence at all. There is less than 0 support for the gold standard on the Federal Reserve, and any real outside-the-box thinking would tend more to isolate her than anything else. So she's not seen as a major threat unless Donald Trump wins re-election and decides to replace Jay Powell as chairman of the Fed with her. But that's 2 years and many political twists ahead, so it's probably not worth worrying about at the moment. Bloomberg's Andrew Husby, though, makes a very good point. We may be focusing on the wrong Fed nominee. Christopher Waller, who is the research director at the St. Louis Fed, was comfortably confirmed out of the Banking Committee yesterday, and he is seen as an intellectual heavyweight, helping turn St. Louis Fed President Jim Bullard into one of the most reliable doves there. And so he could have a lot of influence on the committee because he can speak their language, he knows the ins and outs, and he's seen as a member of the club. So investors might want to pay much more attention to what Christopher Waller is saying, thinking, and writing than Judy Shelton.
Michael McKee, really good final point. We might have a new dove on the FOMC. And what does that mean for rates and the US dollar? This morning, the dollar is breaking down. The euro is breaking out. Euro dollar up 0.5% very briefly with a 116 handle. Matt Hornback and Morgan Stanley saying there might be more weakness ahead. After EU deal, focus will shift to US fiscal and monetary policy. Outcomes that meet all our expectations should boost risk assets further, help the euro, and weigh on the dollar. The second half of July will likely be the most pivotal period for markets since the first half of April. Long euro dollar, short DXY. Matt Hornback joins us right now. Hey, Matt, why will this continue?
John, hey, thanks for having me on. So I think what we're likely to see once we get past the U.S. fiscal stimulus event, hopefully in the next week and a half or so, is we should see a period of what many people are considering to be a risk-off. Month of August typically, on average, is a weak month for stocks. And so I think there is concern building around the outlook for risk assets, which is generally something that would be supportive of the dollar. So you ask, why do we still think the dollar will go down and the euro will go up? And I think in part it's because positioning is not fully short the dollar or fully long the euro at this point, because there's concern about the month of August. Our analysis, however, has suggested that that the weakness that you see in risk markets in August is not statistically significant. We think that there is sufficient cash on the sidelines such that once we move past the next risk event, which is U.S. fiscal, that cash is going to come off of the sidelines to a certain extent. It certainly won't come off in its entirety simply because we have other risk events later in the year that we need to get through. But there's a lot of cash on the sidelines, John, and that needs to be put to work. So our expectation is that will ultimately end up supporting risky assets in the month of August and September.
Yeah.
at which point we could see some consolidation in October ahead of the U.S. presidential election.
On the US dollar itself, though, Matt, you'll appreciate the distinction between a risk on rotation, like what we see in the FX market this morning, and a broad-based, sustained, structural shift lower, a weaker dollar through a series of years. And this, I think, is something that HSBC and David Bloom are pushing back against. David Bloom has described the US dollar as a bad hotel. You might hate the food, you might hate the manager, but you've got nowhere else to stay. Matt, how would you respond to that?
So I'd say a couple of things. Number one, when we look at the yield advantage that the U.S. dollar has enjoyed over the course of the past several years, it does not exist nearly to the same degree that it did. If you look at real interest rate differentials, in certain sectors of the yield curve, they've compressed in their entirety. And this is one of our focal points for the next couple of months, is U.S. real interest rates we expect will continue to fall, goaded along by increasing Fed dovishness. We do have the Fed coming up next week. We're not expecting the Fed to change policy next week, but the press conference could certainly shed some light on the Fed's leanings with respect to policy. And in September, we could see a much more dovish shift in forward guidance. That should put further downward pressure on real interest rates and continue to weigh on the U.S. dollar.
Appreciate that the dollar is no longer the high yielder in G10, but it's not the lowest yielding currency either, Matt. So I'm just wondering how you'd play this dollar weakness through G10 at the moment. Would it be just through the euro or through something else?
So John, we're picking our spots for sure, and the euro features as one of our top picks against the U.S. dollar. We have also liked the Australian dollar, and we have liked the Canadian dollar as well. Those have been kind of the three currencies that we have been most actively focusing on. Now, for most of this year, the euro had not featured in our set, whereas the Australian and Canadian dollars had. But about a month and a half ago or so, we pivoted towards a long exposure in the euro. And with the upside surprise in the European Recovery Fund that we got this week, we think that the euro can continue to gain against the dollar.
Matt, have you been surprised how underwhelming the takeaway from yesterday has actually been? Because I have been. I've spoke to other people that feel the same way. What happened in Brussels was a huge development that we haven't seen quite captured in financial markets in the last couple of days. Why do you think that is, Matt?
So, John, if you look at what the euro has done since that very first handshake agreement between Merkel and Macron, it's gained, well over 6% at this point. That's a decent move for the currency, certainly against the dollar. I would say that, this is the starting point. Today is a great example of a broad-based increase in the euro against a variety of other currencies, not just the dollar. And we think that this is going to continue. This has legs. Again, there's been a tremendous amount of skepticism around the euro area over the years. It's going to take some time for that to fully come out of the market. It's not all going to happen on one day.
Matt Hornback on the FX market. Matt, we'll continue the conversation on the bond market another time. Joining us on this weaker dollar story as the euro breaks out very briefly with a 116 handle. We trade at 115.89. Let's get you some more movers and head back to Abigail.
John, if we take a look at the sectors this morning, we are looking at another flip-floppy day because, of course, Monday was risk off with this year's defense of tech and discretionary hire. Yesterday was all about energy soaring, up more than 6%, really pretty incredible. Today it's a little bit of a mix, and we're probably looking at a neutral risk appetite at this point because up top tech, so some of that quote-unquote defense, followed by healthcare, true defense, but we have the industrials there too. One thing we know though, yesterday's big rally for energy has reversed down about 2%, and on the year, we're seeing something very similar to what we're seeing today.